Hello everyone, Radhe Radhe. In today's lecture, I am going to revise all the concepts of the mutual fund chapter for you in detail. And in this chapter, we saw in our regular classes when we were solving all the questions. This chapter contains certain specific types of questions that are crucial for your understanding. And in this lecture, this dedicated revision video, I will also quickly revise all those specific questions at the very end, ensuring you do not face any problems with the question revision. Apart from this, when we started and thoroughly studied this chapter in class, we covered it in a total of 4 distinct parts. The first part was introduction to mutual funds, the second net asset value, the third returns from mutual funds, and the fourth other topics. This chapter contained 10 topics, completing the chapter. And I told you that this is a very easy and small chapter from which you will generally see at most one question in the exam. So if you revise this chapter properly, you are not going to lose marks in it. You will easily score good marks in the exam. So let's start its revision. So what do we have to learn in this chapter inside mutual funds? Name of this chapter is mutual fund. So first we should know what mutual fund is. First, let's find out what a mutual fund is. After that, we will talk about what we have to learn in it. What does the institute want to teach us in this chapter? So you must have either heard the name mutual funds at some point or used it yourself. And students, what if we have neither heard the name nor used it ourselves? So what is a mutual fund? Let's start with introduction to mutual funds, meaning of mutual funds. What is a mutual fund? I will now explain this. See, suppose I have some money with me today which is simply lying idle in my house. That money is just sitting at home. It's of no use because I am not getting any return. It will just lie there. So I want to invest that money somewhere and make sure that I can earn a return on it. So you can deposit that money in the bank or invest it in the bank. No, I don't want to invest in the bank because the returns there are low. Then no problem, sir. You can invest this money in the stock market, meaning in securities. Invest in things like shares, debentures, bonds because you can get pretty good returns there. When an investor seeks to invest in securities, shares, debentures or bonds, we have studied shares, debentures and bonds as securities in the securities valuation chapter. So when an investor wants to put money in securities, they have two paths. When you invest in securities, remember that if I use the word share, I'm referring to securities. So when you want to invest money in shares and such, then you have two ways. Either I can go directly to the stock market, and in the stock market, I can purchase the shares of whichever company that I want, and I will get the shares. This is one way to invest. We have studied this well in the security chapter. So I can directly go to the stock market and invest in any security. There is another route, which is an indirect route to invest money in the stock market, means to invest in securities. Now, what is this indirect route? Why is it used? Let's understand. Suppose I am a person who doesn't have time to invest in the share market. So what time is needed? You go to any trading platform, place a buy request, and the share is yours. Time means that you have to spend time analyzing the security. We have already studied this. You have to carefully see what the past trend of this company's share has been. Will this share grow in future or its value fall? We invest after analysis. If we invest without proper analysis, our money can be lost, which is why investing in the stock market requires sufficient time. But sir, I don't have time. Or another thing is that I have a lot of available time. I have time of all day. So sir, can I invest in the stock market since I'm anyway sitting idle all day? I have time, but this time I don't have expert knowledge. I don't have expert knowledge because if I want to invest in the stock market, I genuinely need expert knowledge. I should clearly know how to analyze securities, and I will have to consider whether to invest in this particular share or not. I lack that expert knowledge as I haven't studied security valuation, learned to analyze securities or studied portfolio. I don't know anything, I have no expert knowledge, so if I invest money, there will be high chances of losing it. So I am a person with a heartfelt desire. It's been my childhood dream to earn money by investing in the share market. But I don't have expert knowledge, so I am unable to make that investment. Or maybe I'm a person who has time. And let's say I also have expert knowledge and I have everything, but I have a shortage of money. With limited money, I cannot directly invest in the stock market. This is from portfolio management. I have studied in portfolio management that if you invest in the stock market, you should diversify. Diversification reduces risk. As I gave you an example, if you invested all your money in Adani's shares and one day Adani went bankrupt, you would suffer a complete loss. To prevent such a loss, you should have diversified. This means investing in Adani's, Tata's and Reliance's shares. And for that you need money, and I have only 1000 rupees in my pocket. 1000 rupees won't even buy one Reliance share as they usually cost several thousands. So from where will I diversify? Meaning I am a person who has a strong desire to invest in the stock market. But I don't have sufficient time, or I don't have that expert knowledge, or I want diversification with less money. So in such cases, a shortcut method was devised. A shortcut was created to fulfill such people's desires. And when a person needs help, a solution appears almost like a godsend. To fulfill the genuine wishes of such people, a mutual fund was thoughtfully established. Mutual funds were established. In these, it was said, people like you, please come and give us money in our mutual fund. I mean, you should invest your money in us, and then we will invest this money on your behalf in securities in the share market. We will earn returns from there and give it to you. Therefore, this distinct method became an indirect way of investing funds in the stock market. First, what exactly is a mutual fund and what does it mean? An investor wants to invest their money in securities. An investor who wants to invest in securities, so he can go directly to the stock market. And if they don't have time or expert knowledge, or they want diversification with less money, then mutual funds are established for them. The investor invests in this mutual fund. Let's say I'm a mutual fund and I will further invest this money in the stock market. Whatever return I earn, I will pass it on to the unit holders. So this is what mutual fund does. A mutual fund collects money from multiple investors, invests it in securities, and then passes on the returns. This implies mutual funds appear beneficial. They collect people's money, invest it, and give returns back to the investors. In today's world, no one does social service simply for free. The people running these mutual funds are stock market experts, and they are professional fund managers who truly have expert knowledge of the stock market. They don't provide this service for free. Whenever they earn returns from the stock market, they keep a fixed percentage of it for themselves and then distribute the rest of the money to the investors. The returns are then distributed to investors, and this is their income, not social service. Do you understand this point? This is mutual fund. Why is it used? What is the purpose of a mutual fund? A mutual fund is like a trust. It collects money from multiple investors and then invests that pooled money carefully in different securities. A mutual fund is always formed as a trust, and this is because its very name, mutual fund, means it is a common fund for the people. People have come together and they have collectively put money into a fund. A group of people have collectively put money into a fund that will invest in the market and give them returns. That's why it's always like a trust. It is set up like a trust. Just like legal entities are formed, you can register a company or a partnership firm. Similarly, if someone wants to do mutual fund business, they have to get it registered as a trust as per the Indian Trust Act. So a mutual fund is always registered as a trust. You should know this. Now look here, the mutual fund has been set up. What does a mutual fund do? It collects investor money and invests in securities. So now the investors who have given their money to the mutual fund definitely need proof. They need proof of investment in this mutual fund. If a person invests their money somewhere, they would definitely want to show proof of their ownership in it. I need proof, a document to show that I am the owner. What does a mutual fund do when collecting money from investors? The mutual fund issues units to the investor in exchange for that money. In exchange for that money, the mutual fund issues units to these investors. Let's understand this from a company's perspective for a moment. Suppose I am a company. When I have to raise money from shareholders from the market, I collect the money from them and then I issue shares to them as a tangible proof. I issue shares of my company directly to them. So with those shares, they get a right that yes, they are the owners of this company. They can show people that see, we have these many shares. We hold this much stake in this company. Ownership is shown through shares. Similarly, a mutual fund issues units to its investors. They cannot be called shares because a mutual fund is a trust, not a company, so they are named units. It has the same purpose. So as soon as the mutual fund takes money from an investor, it issues them units. So you can also call the investors unit holders now. Just as a company calls its investors shareholders, a mutual fund calls them unit holders. Did you understand this method of mutual funds? For example, suppose I'm a mutual fund and I have collected 1000 rupees from my investors at a price of 10 rupees per unit. Okay, just like a share has a price, a unit has a price at 10 rupees per unit. So I will issue 100 units to the person. If one unit is for 10 and I collected 1000, it means I will issue 100 units to the person. I will issue units and collect the money, which is the mutual funds method. How a mutual fund is set up, this is for practical understanding, not an exam question, so simply grasp it. The introduction I am giving in this chapter, no question will be formed from it. This will prepare your base for understanding and applying the practical concepts of this chapter later on. So just understand this initial base first, which I will explain to you now. Look here. There is a sponsor. A sponsor is individual seeking to operate mutual fund business. The person wanting to do mutual fund business is the sponsor. So who are they? Sir, these are companies with a good background in the financial business. These are generally financial business banks like HDFC Bank and SBI Bank operating their own mutual funds. So these are the sponsors. Suppose there is a sponsor who wants to set up his own mutual fund. How will he set it up? By getting a trust registered under the Indian Trust Act. He will get it registered as a trust. He has to take SEBI's approval, which he will get. The mutual fund is set up. This is called a sponsor, the promoter who started the mutual fund business. Now, since a mutual fund is registered as a trust, its trustees have to be appointed. So the sponsor appoints the trustees. So what will these trustees do? The trustees will see if the mutual fund is doing anything wrong. The trust signifies its people's money, and a mutual fund is a common pool investing in the market and earning returns. The trustees will ensure that the mutual fund is not committing fraud by collecting money from people and not investing anything in the market. These trustees will look after the security of investors to ensure their money is safe and they are getting proper returns or not. This is their job. After this, these trustees will establish an asset management company and appoint its members. Then we need to understand what this AMC as in asset management company truly is. The government has always tried to make mutual funds very independent, and this is to ensure no frauds occur within them. Why do the trustees appoint an AMC? Now understand this. Suppose mutual fund is a vault. It's a vault where many people came and put their money. Okay, many people have put their money in the vault. The money kept in this safe, so who will ensure its safety? The trustee. But sir, was the people's purpose only to keep money in the safe? No. The people's purpose was to put funds in the safe for their money to consistently grow, so that our money grows. Okay, people invest in the mutual fund so that their money can grow. That means the money should be taken out of the vault and invested in the market. Returns should come in and those returns should go to the unit holders. This whole process should happen. So to carry out this process, a particular person is needed. So trustees appoint or form an asset management company which is established just like a normal company. This company specifically hires these fund managers who are indeed genuine professionals with comprehensive understanding of the share market. And those people collect money from the unit holders of the mutual fund. Understand? They invest money in the share market, making careful buy and sell decisions, earning returns and giving them to the unit holders. A mutual fund is like a safe and it needs someone to manage it, right? So this AMC manages this mutual fund, operates it so that it can earn income for the unit holders. This completes the mutual fund process. This is the entire process of a mutual fund, which you don't need to remember for the exam. You must remember this about mutual funds. What does a mutual fund do? It collects money from multiple investors and invests it in the market. It invests it in the market. This is the process of a mutual fund which you should know. So this was the meaning of a mutual fund which I have explained to you. Now come to the introduction part. Classification or types of mutual funds. What is this? We have to study the types and classification of mutual funds because many exist out there. When you go to invest in the market, you get excited to invest in a mutual fund. Now that we have studied about it, then you will find thousands of types of mutual funds there. Every mutual fund has a different name which indicates its type, and you just need to understand that. I will explain it now. You will find thousands of mutual fund types. Then how will you understand which to invest in? So you will invest according to your purpose, because the types of mutual funds are based on their features. If a mutual fund has a specific feature, it is classified as one type, and if another has a slightly different feature, you classify it differently. Mutual funds can be classified in different ways based on their features. For a normal example, understand that there are many smartphones in the market. They are different, they have different features, but the ultimate purpose of a smartphone is the same. The ultimate purpose of every smartphone is the same, but they have slightly different features. Similarly, the ultimate main method of mutual funds is the same: to collect money from people, invest it in the market and give the returns to the people. But they have slightly different features, which is why there are many types of mutual funds available in the market today. You need to thoroughly understand their complete classification, what specific type of mutual fund it is, and then you can decide which mutual fund to wisely invest your money. So for the classification of mutual funds, I have made this chart. This is the final crux chart. In this, I have explained in full detail how mutual funds are classified. If you go to study about classification anywhere else, you surely won't find this detailed chart, as all the information will be scattered there. Pick up any book, not just the institute's module. But a lot of effort has gone into making this final crux chart to show how you can classify mutual funds. Because this is scattered and people in the market know fund types, but often not their true classification. In this chart, I have summarized it all. Now you can understand from this chart how we can classify mutual funds. Now this particular classification is not very relevant for your upcoming exam. A small portion of it will be exam relevant, which I'll discuss shortly. Just understand this as it holds minimal importance. In the classification of mutual funds, first of all, you classify mutual funds on the basis of structure. First, you have to classify mutual funds based on their structure. How is this mutual fund structured and how does it operate? Suppose now today I want to start my mutual fund business, so I first have to set up my mutual fund. In this chapter, you will often think from a mutual fund company's perspective. So today, let's say I want to start a mutual fund business. I need to start a mutual fund business today. So when I want to start a mutual fund business, when I go to register it as a trust and when I take approval from SEBI, I will have to state it first. The first and most important primary condition that I will have to state is whether this mutual fund is an open-ended fund or a close-ended fund. I have to state this first. This is the structure of a mutual fund. This is the first way a mutual fund is classified. You will find this in the name of the mutual fund. Now when you go to the market, you will find a name like HDFC open-ended fund. Alright? So you should understand that it is an open-ended fund. But what is this open-ended and close-ended fund? Now I will quickly tell you what open-ended and close-ended funds are. Look, first we will specifically talk about open-ended funds. Let me tell you, today in the market 99%, or even if I say 99.99%, it won't be wrong. Currently all mutual funds are open-ended. You will find only a very few 1% close-ended mutual funds, and even those are extremely hard to find. All your mutual funds are indeed open-ended, and practically we now consider open-ended funds as the primary mutual funds available. Open-ended funds are the standard mutual funds, and you will rarely find close-ended ones in practice. Why don't they exist? I will tell you all about close-ended funds later. Nowadays, companies only set up open-ended funds. Nobody wants to set up close-ended funds. They are completely useless. So what are open-ended funds? You should understand from the name itself, open-ended, meaning they remain open. So if a mutual fund is a shop, its shutter is open 24 hours. Its shutter is open 24/7, truly meaning its shutter is open every day, 24 hours. What does this mean? Suppose I am a mutual fund. If you wish to invest, you acquire my units. So you come, invest with me, and I will give you units. Another person comes, invests, and I give him units. Today you want to sell your units back. I will take back your units from you and make the payment to you. You can come anytime for unit purchases or sales, and I will manage them directly. I will directly buy and sell units from you. Understand the meaning of an open-ended fund with an example. Suppose Mr. A is an investor. He bought 1000 units of an open-ended mutual fund. On that day, let's say the price of the unit was 10 rupees per unit. So how much money did the mutual fund collect? It collected 10,000. They issued 1000 units to Mr. A. Then a person named Mr. B came. He said he wanted 500 units. Let's assume the price of the mutual fund's unit is still 10 rupees. Therefore, we then collected 5000 rupees from Mr. B and issued him 500 units. Then Mr. A came back to me and said he wanted 200 more units. Assuming the price remains unchanged, I collect 2000 and issue 200 units. Understand this concept carefully now. This means that if it is an open-ended fund, then the investor has the ability to directly buy and sell units from the open-ended fund itself at any given time. If we then look at company shares, a company just issues shares in the market once and the capital becomes fixed. After that, if shareholders want to buy or sell company shares, they must do so in the stock market, trading among themselves. Shareholders can buy and sell its shares among themselves. They can't go to the company and say, please give us new shares. But if the company brings a further public offer, FPO, in the future, then it's a different matter. Otherwise, the shareholders have to buy and sell among themselves in the share market. Understood, students? But if it's an open-ended fund, then investors and unit holders don't have to buy and sell among themselves. If an investor wants my units today as the mutual fund, he'll come directly to me for new units. And if an investor wants to sell his units, I will repurchase those units from him. Just like a buyback of shares, I will buy the units from him. I will give him the money and say, okay, you can go home now. This means an open-ended fund can issue any number of units daily and buy back any number of units daily. Its unit capital is not fixed, it keeps changing. You just need to understand this much. Here, if you want to buy or sell units directly, go directly to the open-ended fund. Unit holders do not need to deal among themselves. Therefore, buying and selling units occurs at a fixed price here, because there is no listing criteria here. In the share market, what used to happen was that when a company issued shares, its capital would become fixed once. They are listed on the market. If shareholders want to buy or sell companies' shares, they go to market and do it. Their prices change by demand and supply, the market price. The market price of a share moves according to demand and supply. I had explained this to you. But here units are to be bought and sold directly from the mutual fund company. Here the price is not affected by demand and supply at all. There is no listing in the market. Unit holders do not interact among themselves. It's a simple matter. Let's talk about me today. I provide classes to you all here for FRA, AFM and other subjects. So you all come to my website and order for classes, but I don't change the prices of the classes based on demand. It's not like if more people are asking for it, then I'll increase the price. Prices don't decrease if fewer orders come in. They remain fixed as I decide. Fixed whatever price I decide, that's what it runs on. This applies to open-ended mutual funds where buying and selling of units happens directly from the mutual fund. Unit holders don't trade units, the price is fixed. So are you trying to say, sir, that the unit price here is fixed by the mutual fund itself? It cannot fix anything on its own. There is a method to calculate the price. I will teach you that later. That's what we have to learn in this chapter. I told you what we have to learn. We have to learn how to calculate the price of one unit. We will discuss all that in detail, which we call NAV. We call this NAV. We have to learn this next. Understood what an open-ended fund is? I have explained the process of an open-ended fund to you. See, what happens in this is we always understand mutual funds with a balance sheet because this is the way to understand this chapter. This way you get complete clarity. First, mutual fund collects money forming unit capital. Suppose 1000 units yielded 10,000. The bank 2 unit capital, the bank balance became 10,000. But the mutual fund invested rupees 8,000 out of rupees 10,000 in the stock market. Bank balance decreased to 2,000 with 8,000 invested in security. This shows a mutual fund's balance sheet preparation. This will be useful later when I provide you the reference point. Now suppose one day the mutual fund issued 500 more units, causing its capital and bank balance to each increase by 5,000. This is how the whole process of a mutual fund continues. This is an open-ended mutual fund. Now all funds in the market today are open-ended. Close-ended ones are very few. Now what is this close-ended? What is the meaning of a closed-ended fund? Suppose I set up a closed-ended fund. Suppose today I am bringing 1000 units in the initial public or new fund offer. A mutual fund's initial unit issuance is called a new fund offer. Just like when a company issues shares, it's called an IPO, initial public offer. Similarly, mutual funds call it an NFO, essentially an IPO. Name doesn't matter. So when a close-ended fund issues units for the first time, its unit capital gets fixed right there. This happened in company's case. So I issued 1000 units and now it's fixed. Now the unit holders who have these, if a new unit holder wants to buy more units, they should meet the old unit holder and buy or sell. As a mutual fund company, I'm not going to issue new units directly, nor am I going to buy units from anyone. Unit holders can buy and sell units among themselves if they want. That's why in this close-ended fund, I issue units once and then I get them listed on the market. Just as a company issues shares and gets them listed on the stock market, a close-ended fund issues its units once. These units are then listed. Any unit holder wanting to buy or sell their units can go directly to the market and perform the trading. Buy and sell it. It's the same method, and here its units price will also come from demand and supply. Because it is listed in the market, the buying and selling will happen at demand and supply price. The units price will be determined by demand and supply, and all the transactions will occur at that price. So a close-ended fund is just like shares, just like a normal company. That's why close-ended funds are not treated like mutual funds, so people don't set them up in the market. It's like a normal company. You generally get open-ended funds. This was the first classification of a mutual fund. Now look, suppose I saw in the market, it was written HDFC open-ended mutual fund. From this you should now understand, the first word written before the mutual fund in the market is the name of its AMC. Asset management company that runs that fund. Then the mutual fund's features are written, indicating it's open-ended. You now understand open-ended funds generally found in the market. Now look ahead. On the basis of structure, you have classified the mutual fund as open-ended or close-ended, and after this it can be further classified. Open-ended or close-ended, both funds can be further classified on the basis of their investment portfolio. So what is the investment objective of these mutual funds? What is the investment objective of these mutual funds? Suppose I set up an open-ended mutual fund. While close-ended funds also exist, we won't specifically discuss them now. Suppose I started an open-ended fund. And in this open-ended fund, I told people to give their money to me and I will invest this money in shares. I will invest it in equity shares. So my investment objective is to invest in equity, meaning this is an equity scheme. So you know this fund will be called as HDFC Open-Ended Equity Fund. Therefore, you all should understand by looking at it that if an investor puts money into this particular fund, it will then invest this money in equity shares and earn returns from there. There is a debt scheme and a hybrid scheme. A debt fund collects money from people, investing it in debentures, bonds, and similar instruments. Hybrid fund means I will collect money from people and invest some in equity and some in debt. How much, sir? That ratio is written in the mutual funds document. People are told about it. Suppose 60% equity, 40% debt, it can be anything. People decide which mutual fund to invest in based on their specific needs. If a person feels that they can take more risk because they want more return, they will invest in an equity fund. If a person feels that they want less risk and are satisfied with less return, they can invest in a debt fund. Have you understood the classification? Mutual funds are classified on the basis of structure, open-ended, closed-ended. After that, it can be further classified on the basis of its investment portfolio, an equity scheme fund, a debt scheme fund, or a hybrid scheme fund. After this, mutual funds can be further classified on the basis of their income plans. It's important to know from exam perspective, it will be useful. On the basis of income plans, mutual funds can be further classified. Let's understand with an example. Suppose there is a fund, HDFC Equity Dividend Payout Fund. HDFC means that this is its AMC fund, and equity means this fund will further invest in equity. Now what does this dividend payout fund means? Now understand carefully dividend payout fund. Based on the income plan. Mutual funds can be of four types: dividend payout or regular income plan fund. A dividend payout or a regular income plan fund, it can be called by either of these two names. Or there's a dividend reinvestment fund. Or there's also a bonus fund, and then there's a growth fund. Based on income plans, mutual funds have four types. Let's discuss the dividend payout or regular income fund. Let's understand what this is. Understand it from its name. Dividend payout means this fund will provide a regular income. This fund will give us a regular income. Let's assume that I am a dividend payout or a regular income plan fund. So the investors in front gave me money. I invested the money in the share market and earned returns from there. How are returns earned? The share price increases, that's one thing. And second, our other return comes from dividends. Suppose I invested all money in equity shares. I received dividend from there. The dividend was received, so who has the right over it? The owners of this mutual fund are the investors. The owners will be those who put money in this mutual fund, the investors or unit holders. So who should get the dividend? Those unit holders, the investors. With a dividend payout fund, any dividend that the fund has earned is distributed to the unit holders and the investors. This is what we call a dividend payout or regular income plan fund. It's simple that Mr. A bought 1,000 units in a dividend payout fund. Now one day this dividend payout fund paid a dividend of 0.20 rupees per unit. Mr. A, holding 1,000 units, will receive a 200 rupee dividend. In a dividend payout fund or regular income plan, if I am such a fund, I earn dividends and other income from my investments. Then keep distributing these to the unit holders, either monthly, bi-monthly, quarterly, or as I choose. But I will keep giving them income in their account from time to time. Did you understand this? If it's an equity fund, then they will earn dividends and distribute them. But suppose I were a debt fund, I had only invested in debentures, bonds, then there would be no dividend income, only interest income happens there. So what would happen if it's a dividend payout or regular income fund? In such a scenario, the interest you have clearly earned will be paid out. Interest is also an income. In this chapter, if there is a dividend payout, it means an income payout. We are paying out all types of income to our investors and unit holders, whether it comes to me in the form of a dividend or in the form of interest. In this chapter, understand the meaning of dividend. Dividend comes from shares and interest income is what comes from debenture bonds. I will pay that out. Just keep that in mind. This should be clear. Second, the dividend reinvestment fund. What is a dividend reinvestment fund? In this, I am the dividend reinvestment mutual fund and I will invest and earn dividends. I will now declare that I am paying so much per unit. Unit holders have a right to the dividend and I will declare that dividend amount per unit. But the dividend that I will announce per unit for the unit holder. I will not put dividend in their account. I will not put that dividend in their bank account. For example, Mr. A has 1,000 dividend reinvestment units. This fund announced a dividend of 0.20 rupees per unit. How much dividend was made? A total dividend of rupees 200 was made, which Mr. A should receive. But now this is a dividend reinvestment fund. This time I am not going to deposit this amount of rupees 200 in Mr. A's bank account. What will I do? I will tell Mr. A, look, you are entitled to a dividend of 200. Your dividend payout is 200. But I am assuming here that today you are going to reinvest this amount of money back into my fund. So today you are giving this money back to me as in the mutual fund. So whatever the price of one unit is today, I will assume that Mr. A has reinvested this money in my fund at that price. Now I will again invest this money in the market. So this is dividend reinvestment fund. So let's say today the unit price was 10. So Mr. A's dividend was 200. The price of one unit is rupees 10, which means I will assume that I have issued 20 units to Mr. A today. I will issue 20 units to Mr. A today. This assuming that Mr. A has reinvested his entire dividend payout at today's prevailing price. A dividend reinvestment fund. Did you understand? One is a bonus fund. What will happen in a bonus fund? I'm a mutual fund. I will invest money in shares, debentures and earn an income. But I'm not going to put this income in the unit holders' accounts. I will not distribute this income, instead retaining it myself. So what will happen in a bonus fund? In a bonus fund, whenever I feel like it, I will issue free bonus units to the unit holders. Suppose one day I felt like giving a bonus of 1:5. Mr. A had taken 1000 units. 1:5, I will issue him 200 units for free today. This is a bonus fund. Now growth fund. What is a growth fund? In growth fund, I am not going to give any dividend payout to the unit holder nor any bonus units. I am not going to do anything. So in a growth fund, the price of the unit holder's unit, what we were calling NAV, that grows at a much better speed and it increases more. Ultimately, what is it truly about? The investors are always most concerned with their return, with the earnings. So what is the source of earnings? The main earnings come from the increase in the unit's price. If you invest in shares, your main earning is from dividend or its price increase, the share price. Similarly, the major earning in a mutual fund comes from the unit's price increase. So if it's a growth fund, the unit price will increase more. In other funds too, the unit price increases and decreases, but in a growth fund, the impact on the unit price is greater. It increases more compared to others. So am I saying we should invest in growth funds? Not necessarily. If you see practically in all funds across all types of income plans, you will get the same type of return. There's a difference of 2-4% up or down. How is that possible? I will explain it with an example. Try to understand. Suppose a mutual fund is a vault. People put money in a vault. This mutual fund invested the money further and earned returns like dividends. And this dividend was taken out and distributed to the investors. Let's say it's a dividend payout. The investor receives the dividend payout. While unit price increases are expected, the vault's balance decreases immediately upon dividend distribution. Unit price won't increase much. And if this were a growth fund, investors put money in the vault. The money invested in the market, all earnings remained in the vault and distributed. The vault value increased and unit price rises more. So the return is approximately the same no matter which fund it is. In practical life, growth funds are the most popular. Dividend payout or dividend reinvestment funds are less common. Bonus funds are discontinued. Institute still asks questions. Then you must learn them. Remember this, practically creating new bonus funds is no longer allowed because SEBI has stopped it. I have explained mutual fund classification in our introduction. You can classify them in 4 ways based on the income plan: dividend payout or regular income. Meaning in this, the mutual fund will distribute dividends to the unit holders from time to time. Dividend doesn't just mean dividend, any income earned like interest is also distributed. In its dividend reinvestment plan, we don't deposit the dividend in their bank account, but we assume that the dividend amount due to the unit holder has been reinvested. From the unit holder, we have reinvested it within the fund itself at today's price. In a bonus plan, we give no dividend or income instead. We periodically issue free bonus units. In a growth plan, neither dividends nor bonus units are given. In this, the NAV itself keeps growing. NAV means the price of the unit. This was the introduction to mutual funds, and you must have understood it. What is a mutual fund and what does the institute want to teach in this chapter? The unit price which we keep discussing means NAV. So we have to learn to calculate how to find the price of one unit. Second, we saw that there are so many plans. In them, what return will the investors of the mutual fund, the unit holders, earn? So we have to learn to calculate the return that we will get from the mutual fund. So this is your part 2 and part 3 of this chapter. Now we discuss part 2, net asset value of a mutual fund. Net asset value is the value of one unit of a mutual fund. We have to learn to calculate the price of a mutual fund's price unit. What is it? So first, the meaning of NAV or net asset value of a mutual fund. I have explained what NAV or net asset value means for a mutual fund. NAV is the value of each unit held by an investor or unit holder. A unit holder or an investor has one unit of a mutual fund. What is the value of that one unit? What is the price of that one unit? What is the price of one mutual fund unit and what is its value? That price, the NAV, is what the buying and selling of mutual fund units happens at. I told you it's an open-ended fund. Investors buy and sell directly from this fund at the NAV, and this occurs at the NAV. Generally, it happens at the NAV. However, any specific adjustments to this will be discussed later. NAV, the unit price, is not determined by demand plus supply because it is unlisted. The mutual fund itself is directly responsible for issuing new units or repurchasing them. So will you calculate that NAV? We will now discuss how to calculate that NAV, and this represents the actual real unit price. Don't think of it like intrinsic or fair value. For example, with shares, the market price was different and we used to calculate the intrinsic or fair value to make decisions. It's not like NAV is the actual price at which buying and selling happens. This is the actual price where transactions occur, and no intrinsic fair value concept applies here. because you directly get the fair price through the NAV. The actual price comes. I will explain now how to calculate it, then you will understand this point. After this, the NAV is calculated on a daily basis. The mutual fund has to calculate the NAV daily. Daily means as soon as a day completes, at the end of each day, the mutual fund calculates and publishes its NAV. The mutual fund calculates and publishes its NAV. As a chartered accountant, for example, if you are working in a mutual fund company, you will be asked to calculate and publish today's NAV, which ensures that unit holders know the exact value of one unit. So this is the important work you have to do, and we need to calculate NAV from a mutual fund company's perspective. So how do we calculate NAV? Look, NAV calculation is very simple. How is net asset value NAV going to be calculated? So in a mutual fund, multiple investors put in money, and this mutual fund further invests in securities and earns returns to give to the investors. A mutual fund is a kind of common pool. It's people's money from a common pool. People have collectively put money into it and they want to earn returns by investing it further. Who has the right to this money? The investors who invested it, they have the right because it is their common fund. People have mutually put their money together, a common pool for further investment. So who gets the right to this money? It is the investors. So now let me explain with another example. Let's say I and 4 or 5 students get together. Now we start a project together. So the money from that project, among whom will it be divided? It will be divided among all 4 or 5 of us. It's a simple thing. Similarly, many people have invested money in a mutual fund, and that money is further invested in the market. How will it be divided? It is distributed to these investors, their owners. How will you distribute it? It is very simple to understand this by looking at the mutual fund's balance sheet. That's why I discussed about the balance sheet, because that's the only way to understand it. The mutual fund issued 1000 units at 10 rupees, and this generated 10,000 rupees. 10,000 rupees will be the fund's unit capital. After this, on a particular date, the mutual fund's investment in the market, its market value has now become 15,000 rupees, and today the cash that the mutual fund currently holds is 3,000 rupees, reflecting its available cash balance. This money was collected from people, then invested in the market, and we have taken its market value today. And there are some expenses payable. There are also mutual funds expenses that would have become due, but it has not paid yet. These are the fees of the fund manager professionals who manage the mutual fund, and so on. What is the mutual fund's net money now? How much money do the investors have a right to this net money? This asset, whose is it? It belongs to these investors. The mutual fund's market investments, who owns them? The investors. Who owns the mutual fund's cash? The investors. Investors having rights to the fund's assets must also accept responsibility for its liabilities. Therefore, this entire net money belongs to these original investors. Net money 18,000 assets minus 2,000 liability, 16,000 rupees. Total units 1,000 unit holders. A total of 1,000 units. So what's the per unit value? 16. That's all you need to calculate for NAV, the net asset value. What is the net asset value? You always calculate 1 unit's value, since NAV is always per unit. It is simple. Distribute the mutual fund's net assets among unit holders. That's the value of 1 unit. Just take the net asset at market value. Here you'll see your balance sheet is not matching. Net assets are at market value. Think about it. If today I want to withdraw my money from this mutual fund as an investor, today any securities investment will need to be sold and its market value realized. The cash balance remains as it is, and any liability will be paid. So today, this is the net money that we will realize. As an investor, I want my money back today. The net amount realized after receiving assets at market value and paying liabilities is the net money I will get. This is divided by the number of units. So you get the value of 1 unit. So this is always the actual price from the beginning. Calculate this. Buying and selling happens at this price. The mutual fund's NAV is very simple. How will you calculate it? In the first step, calculate the net assets of the mutual fund at market value. Take it at market value. What assets can a mutual fund have? I am a mutual fund. I have invested in the market, shares, debentures, bonds, their market value. Apart from this, any accrued income from the investment in shares, debentures, or bonds. I invested in shares. The company announced a dividend, but not yet credited to my bank account. The dividend has accrued, my income has accrued, so the accrued income is my asset, so I will add it. Apart from this, I am a mutual fund having some cash with me, my current closing cash balance today. This is my asset. Accrued expenses in liabilities. I am a mutual fund. I have hired employees and I have hired fund managers. Their fees which were due, but I haven't paid them yet, so the expense has accrued, so it's a liability. Arrears of expense, this is expense payable. After this, if there is any other liability, then subtract that. I'm a mutual fund. I collected money from people and invested it in shares. So I invested money in the shares of a company, the company which collected the money in stages. You have studied this in 11th and 12th class. A company asks for share application money, then share allotment, and then first and second calls. So the other company had collected the money. In a 100 rupees share, it was 100 rupees per share. It has issued all the money, collected all the money, and specifically asked for all the money. Application money, allotment money, first call, second call. It has called for the full 100 rupees. But as a mutual fund, I have only given it rupees 80 so far. When I bought shares in the other company, I gave it rupees 80. I haven't given rupees 20 yet. The company had already requested the funds. Therefore, my liability has now clearly arisen, and this unpaid amount payable on shares is a potential liability for the mutual fund. So this is net assets of mutual fund. The net amount is for unit holders and you divide by the units. So we get NAV. Calculating the mutual fund's NAV is a very simple two-step process, and questions are generally based on it. Remember these points for the exam. Always calculate NAV and number of units to 2 decimal places, unless the question specifies otherwise or asks for complete rounding. Use 4 decimal places if specified. Unless specified, always calculate NAV and units to 2 decimal places. Since NAV is price per unit, so there's no problem with that. It will be in 2 decimal places. But how can the number of units be in decimals? For example, if I want a share of a company, I can easily take 1 share. You can take 2 shares, but you cannot take 1.5 shares. Have you ever heard of any company's shares being available in decimals? However, a mutual fund gives units in decimals. A mutual fund is not a company, it's a common pool of money. So when an investor puts money in it, suppose I am an investor, and I have told the mutual fund that I want to invest 15,000 in the mutual fund. I am an investor, I want to invest 15,000. Today the unit's NAV is 13 rupees per unit. In mutual funds, investors invest the total amount. Here this mutual fund then issues units in decimals up to 2 decimal places. Units can indeed be in decimals because ultimately all the pooled money must be distributed among the unit holders, and its decimal nature truly does not matter. So here units can be in decimals, so always take units up to 2 decimal places. Unless told otherwise, always take them. If you round it off and the question doesn't specify, that will be wrong. Then you will say the institute doesn't give marks. Look, it's just a rounding off mistake. This is not a rounding off mistake, but a conceptual error. Many will come on YouTube saying the institute didn't give marks due to rounding off. What can students do? Those people lack knowledge and misguide students. It's not about rounding off, it's a logical thing. Some things are logical and you have to follow them. It's not merely rounding off, it's logical. Units are in 2 decimal places, meaning they are. Now if you round off for your convenience, for your ease, then you are getting your marks deducted. It becomes clear right there. Keep this in mind. Clear? So this is one thing of your mutual fund. One point to note within this is NAV within NAV calculation. In NAV calculation, see the second note. Look at the third note. We have to calculate the closing cash balance when it is not provided within the question. I have to calculate NAV today, but cash balance is unavailable. If available, no problem. But if not available, I will calculate it. And how? We will make a statement. So do we need to memorize this? No, you are account students. You know accounts. This is an account statement, effectively a cash ledger. Just understand it that way. It is just not in the ledger format, and you should not make it in the ledger format either. Some people easily show how to make it in the ledger format, no problem. It seems easy, but it means 0 marks. We find this approach very good and helpful because a good teacher clearly explained everything in the ledger. We understood it easily, but you won't get marks. In the actual class, I teach both things, concept plus what will get you marks. We take both those things in parallel, so you just have to run both those things in parallel. You must calculate in the statement itself, because if at this crucial level you cannot, then your studying is simply useless. In the statement form, you are making a ledger account of cash and nothing else. How to make a ledger account? It's simple. Let's start from the beginning. First, a mutual fund issues its units. When units are issued, the fund receives the money, then record the amount from issuance. After this, when a mutual fund issues units for the first time, there are some expenses. Flotation costs, paperwork, all these expenses are there. So the initial expenses will be from this money. Subtract it. If money goes out, then subtract. Add incoming money, subtract outgoing money. When I first collected the money, initial expenses were incurred. And remember, you must always consider everything including incoming funds from the mutual fund's perspective when calculating NAV. So money went out, so I subtracted it in initial expenses. Apart from this, money came to me. I will invest that money in the market initially. I will invest in some securities, so money will go out, so I will subtract it. So initially you will be left with some amount. Some amount might be left with you. It's possible. What other cash adjustments are there? During this period, I sold some securities in the market. These investments were made from previously collected funds. I invested in the market in shares such as Reliance, Tata, Adani. Now one day I felt this Adani share is at its peak, let's sell it and get out. The price will fall later, so I sold this share. When a security is sold, money is received into the fund, therefore at the amount from its sale. One day I felt that this XYZ company's share price can increase, let's invest in it. I purchased its securities and the amount was paid for their acquisition. Look, I have invested in market securities like shares, debentures and bonds. So from that, I received income from dividends or interest in my bank account. If received into the bank account, add. If your income was accrued, though not in bank, it becomes your asset. It's a simple thing. If received in bank, cash balance increases. If I have a dividend payout or a regular income plan, I will then distribute all earned income to the unit holders. So realized earning paid to unit holders, money will decrease. What income do you distribute to unit holders? We distribute dividends or interest earned from investments, calling this entire amount income, dividend and interest distributed. Also in dividend payout or regular income plans, another important thing is also distributed to the unit holders. Capital gains arising from the sale of securities. This is also distributed. What is this? It's a very simple thing. Look at the example. I have already mentioned a point about the sale of security here. One day I thought my investment in Adani shares as a mutual fund. Considering this Adani share was at its peak, it was promptly sold for 70 rupees each. So when I sold it, rupees 70 came into my bank. Suppose I had invested in only one share. And when I had bought this share, I had bought it at rupees 65. Whenever I bought it earlier, when I invested in it, I must have done it at some point, right? I had bought it at 65. How much did the mutual fund earn on the Reliance share? It earned 5 rupees as real profit. Having been sold, it earned 5 rupees per share. This represents the mutual fund's capital gain. Yes, it is the fund's actual capital gain, and the mutual fund then distributes this to its unit holders if it is a dividend payout plan. This is also distributed. This is also distributed. So this capital gain of rupees 5 can also be distributed. So sir, whatever dividend or interest or capital gain we are earning, we pay the entire amount to the unit holders. Mutual funds can decide a percentage. The mutual fund said that whatever dividend we have earned, we will distribute 80% of it. So you will do 80%. The distribution depends on the mutual fund's announcement as it's their choice. Whatever is distributed, deduct it. After this, look. This mutual fund issued new units in the market, got money, so add it. I am a mutual fund. When I repurchased units, unit holders sold theirs and exited, so I paid them. And my money certainly would have gone out. So closing cash balance. Beyond what we've discussed, a mutual fund also incurs operating expenses, like the fund management fees I previously mentioned. I said earlier that the mutual fund deducts its money, so it takes out its money from here. Operating expenses less. Operating expenses will be paid in cash, right? If they become due and are not paid, they will come under liabilities. Clear? This is accounting, nothing new. Once the closing cash balance is determined, your calculation is straightforward. So this is how you calculate NAV. And based on this, we did many questions after studying this much. Those questions are generally based on this. I will now tell you a few more things not very useful for the exam, but essential for knowledge. Someone might have thought when mutual fund first issues units. So at what price would it do it? Later when it issues units, we can calculate the NAV. Buying and selling at NAV, correct. But when a mutual fund first issues its units, what is that initial price? There is no NAV available then, as the fund has just been established. So when a mutual fund does it, it can be at any price. You can do it at any price, it doesn't matter. Because that initial price will itself become its NAV, and in practical life, units are generally issued at 10 rupees per unit. Understand with an example how that becomes NAV. A mutual fund is a box where people put money. Suppose a mutual fund issued 1000 units at 10 rupees. So a unit capital of 10,000 rupees came in. The asset side shows 10,000 rupees in cash. What was the initial net asset? On the initial day, the net asset is 10,000. So that means the NAV of 10 per unit came on the basis of net assets. The first time a mutual fund issues a unit at any price, that becomes its NAV. So there is no problem in that. This is a normal point. I have told you this if you need the knowledge. Clear? After this, now look ahead. The NAV discussion continues and I have explained 2 notes. Now we will come to the third note. Look at the third note. For example, to calculate the NAV of a mutual fund on a particular day, we need the balance of assets and liabilities for that day. But the question does not provide you with that. So in such a case, how will you calculate today's NAV? So you must be given some opening NAV. So if you need to calculate the closing NAV of a mutual fund and you don't have the balance of assets and liabilities for that day, in that question, you will be given the opening NAV and using that, calculate the closing NAV. It is very easy and there is one question on it, so we are looking at this. Look how you are going to do it. I will explain with an example in an easy way. Opening NAV, closing NAV, everything. Suppose the mutual fund's NAV which was there on 1st April is given in the question. It is asking you to calculate the NAV for 30th April. On 30 April, balances of mutual funds assets and liabilities are not known. So how do we calculate today's NAV? So you are given a different NAV for when? 1st April. So this becomes our opening date. The description given is our opening NAV, and when we calculate today's NAV, it will be the closing NAV. It's a simple thing. You have the opening NAV. You have the opening number of units, and you also have the opening NAV. If you multiply them, you will calculate the total net assets for 1st April. The NAV per unit is calculated by dividing total net assets by units. To find net assets, you multiply the units by the NAV. So if you multiply the opening NAV by the opening number of units, you will know the balance of net assets on 1st April. You have to calculate today's NAV. So you need today's net assets. That is for 30th April, which I am calling closing net assets for now. This comes by applying accounting principles. You are given the opening balance and you have to find today's balance. So consider changes during this 1 month period. You should consider the changes in my net asset balances during this 1 month period. In such questions, these are always given because otherwise calculation is impossible. So the changes during the period are given in the question, adjust them and you will get today's NAV. Let's see how you guys do it. Take the given opening net assets of the mutual fund. Number of units at the opening date will come from in opening NAV. Then you must include changes between 1st April and 30th April. So between 1st April and 30th April, I as a mutual fund had invested in shares in the market in securities. My investment portfolio's value would have increased or decreased, showing appreciation or depreciation. Take that change. So if it increased, my net assets will increase. If my investment portfolio's value increases, my net assets will increase, and if it falls, net assets will fall. For appreciation, add, and for depreciation, subtract. You are doing simple accounting things and nothing else. Besides this, a mutual fund's assets also clearly include the cash balance, and we need to determine its specific changes during the period. So during the period of this 1 month, if I have issued any new units, so with the money, the cash balance and the net assets would have increased. Number of units issued into issue price. If during the period of this 1 month, I have repurchased any units, meaning money would have gone out, so the cash balance would have decreased. Number of units repurchased into repurchase price. During this period, if I have earned income, I invested money in securities, and from there, if I have earned dividend or interest income, I should add it. Does income to come mean it is deposited in the bank? No. Whether income has come into the bank or it has accrued, in both the cases, you will add the total income. Why is that? Because look, if it hasn't come into the bank, it would have been accrued, so the accrued income asset would have increased. If it came to bank, cash asset increased, or if accrued asset increased. So the total income earned during the period will be added. Apart from this, during the period, I distributed some income to the unit holders, which means paid it to them. Cash balance decreased, then minus. During the period, I sold some securities where I had invested, so money would have come in. So add. New securities purchased, money went out, minus. If any expenses are incurred, then subtract them during the period. I mean, these are just some examples of possible changes in the cash balance. Could there have been a change in the cash balance like this? Why didn't you take that? It could have happened. Everything could have happened. I have taken some scenarios. There can be many more scenarios, and you should always actually understand the underlying concept. So you will get the closing net assets. Once you have the closing net assets, take the closing units. You will get the closing NAV. It's very simple. There is a big question that often scares people, making the students worry about its difficulty for the exam. Do not be scared. This is a basic question, and if your concept is clear, what is in it, we have solved it in class. So you know how easy this question was. We will now discuss some other important points in this question. Now you might say, sir, when you were explaining these changes, you were talking about issue price and repurchase price for the units being issued and repurchased. Issue and repurchase prices will be that day's NAV. As you know, a mutual fund issues new units at NAV, and it also repurchases them directly at NAV. It does it at NAV, but sometimes adjustments are made to it. The issue price and repurchase price can sometimes be different. I will teach you how to calculate this per unit of a mutual fund. How to calculate the mutual fund's issue and repurchase price. See the issue price per unit, which is also called the public offer price. That is the price at which a unit holder can buy new units. So generally it is the NAV. Whatever it is today, if units are being issued today, then they are issued at whatever the NAV is today. Plus sometimes a mutual fund says that it also wants a certain percentage of entry load on the NAV, which is also called a front end load. For example, understand this. I am issuing new units today and therefore today's net asset value is 40, and because of this I should be collecting 40 rupees from each person for one unit. However, mutual fund professionals are sometimes bad and these individuals can be very greedy indeed. They said that we will not issue units at NAV. If you want to enter our mutual fund, you will have to take an entry. To enter, you will pay 2% extra on the NAV. This is called an entry or front end load and added to get your issue price. So sometimes an entry load of a certain percentage is also charged on the NAV, which we call an entry load or front end load. In practical life, the entry load has been discontinued because it is wrong. SEBI said, what is the concept of entry load? Mutual fund is people's money. People's money, if distributed among the people, the price that comes is the NAV, and that is indeed the correct price because it is people's own money. So units should be issued at that price. What's the concept of entry load? Why are you collecting extra money? So it doesn't happen in practical life, but it will be in 1 or 2 questions of the institute that we do, not in all. It's only in 2 or 3 questions which don't have much relevance. So the concept of issue price and all is not very much useful for you. So the mutual fund is collecting this money. At the same time, it is also collecting an entry load, so the entry load is added to it. Apart from this, when a mutual fund issues new units, so dividend equalization is also collected per unit from the investors. What is this dividend equalization? I will explain it in a while. This is collected by the mutual fund which has a dividend payout plan. This happens only in the dividend payout plan, otherwise it won't. What is this? I'll explain it shortly. It's an easy concept. These 3 things are collected. I have to collect all 3 while issuing new units. Adding all 3, this becomes the issue price. What is repurchase price and redemption price? Repurchasing the units from a unit holder means they sell their units and take their money back. I will pay them the NAV of that particular day. Repurchase at that value is paid. But mutual fund says, the mutual fund says that whatever the NAV, I will give you that amount, but after deducting an exit load. And because you are giving me back your units and taking your money today, I simply will not give you the full amount. I will deduct a certain percentage of the NAV, which is called an exit load or a back end load. For example, if today's NAV is 50 rupees and some active unit holders come and say they want to sell their units back, the mutual fund will then repurchase them. So if there's a 2% exit load given on NAV, the unit holder only gets 49 rupees. Upon repurchase, I have to give them money. I want to deduct something from my NAV, which is why the exit load is subtracted. Some students question that why is this subtracted and not added to the NAV? Understand the concept, not memorize. You have to think simply, this NAV is a payment. I want to reduce the payment, and so I am applying an exit load. To reduce it, you then have to subtract it. Is exit load applied practically? Yes, it's still practically applied today. The exit load is practically applied because, understand this, if there's no exit load in a mutual fund, do you know what unit holders do? Suppose a unit holder comes today, buys a unit and sells it the next morning. The NAV changes and they profit in selling. So they will then buy it and sell it again. People will keep doing this, and practically transactions of 10-20,000 units happen daily for issue and repurchase. Mutual fund managers face considerable effort because their staff handles fees and paperwork. They are going through a lot of hassle, and that's why mutual funds apply an exit load to avoid this trouble. What will happen because of the exit load? The unit holder will think twice whether to sell today or not. Also, practically, mutual funds apply the exit load with a condition. What do they tell investors? If you sell your units within 1 year, an exit load will be charged. Otherwise, it won't be. Meaning, if you sell after 1 year, we won't apply an exit load. Such condition can be applied. Whatever it is, check that. After this, look at dividend equalization paid on repurchase of units. When the mutual fund repurchases the units, meaning it takes back the units and gives money to the unit holder, the dividend equalization per unit is also paid to them. I use the word paid. So this will also be added because this is about a payment. Since it's about a payment, it will be added. The same thing applies here. Sir, at the time of issue, during collection, the dividend equalization was being added. At repurchase, dividend equalization should be subtracted. You see, because our logic is based on memorization. Adding there, subtracting here is not how it works. This is a payment. This repurchase price is also payment, and these payments are added. So that's the whole concept I explained about issue price and repurchase price. Finally, what is dividend equalization? We will now proceed to understand this concept. This concept is simple, we'll understand it by example. Understand dividend equalization by example. Dividend equalization only occurs with a dividend payout plan, and I am using that example. Initially, this specific mutual fund configured with a dividend payout plan has already issued 1000 units in the market. During my first month of operations, I earned an income totaling 15,000 rupees. For dividend equalization, you need to create a format which I have made here, which is also written in the notes. I will revise it all now with an example. I have written some items in the format: particulars, number of units, per unit income, and total income. In its first month, the mutual fund earned income from the market, dividend, interest, whatever the income is. In the first month, I earned an income of 15,000 rupees. See, I have issued 1000 units in the market. This means a unit holder's income share is 15. Income has not been distributed, but their share is 15 rupees per unit. Then came the second month, May. In this, I earned an income of 25,000 rupees from the market. In this 25,000 rupees income, a unit holder's share is 25,000 divided by 1000, making it 25 rupees per unit income. Alright, now see what happens. Now look here in this. The mutual fund's goal is to secure more income in the third month, which is June. The fund anticipates earning another 20,000 rupees from the market. Its total income reaches 60,000. How's it 60,000? It had earned 40,000 rupees income up to this point here. In third month, it will earn 20,000 rupees more, making it 60,000 rupees. It distributes income to unit holders. I want to distribute income to unit holders after third month. You can distribute the income to the unit holders after the third month, but the mutual fund will earn this income at the end of the third month. Before that, at the beginning of the third month, meaning at the end of the second month, the mutual fund will issue 200 new units in the market. They are going to be issuing 200 new units in the market. Once 200 units are issued, then the total units by the third month's end will be 1200. A mutual fund operates like this. So it earns income all at once and then checks total units issued in the market. When the mutual fund distributes income by third month's end, the total 60,000 rupees income will be distributed to unit holders. Assume an income distribution box holds the distributable income. So far there are 60,000 rupees in this, 1200 unit holders. Then divide 60,000 by 1200. The fund will distribute 50 rupees to each unit holder. A mutual fund cannot track when unit holders joined because thousands of transactions happen daily. The fund distributes equal income to all unit holders, depositing per unit income into their bank accounts on the distribution day. What happens here as soon as the mutual fund does this? These 1000 unit holders, these initial 1000 unit holders, they will get angry. They will say, what is this you are doing? They will say that we had invested our money from the very beginning. So we have right to all the income. But these new 200 unit holders, these people who invested at the end of the second month, that is at the beginning of the third month, how can they have a claim on the income of the previous 2 months? These unit holders should only have a claim on the income of the next month, that is this 20,000 income. The previous 40,000 income belongs to us, the 1000 unit holders. And that's fair. It's a simple matter that these people have had their money invested for longer. The mutual fund earned the 40,000 income from 1000 unit holders. These unit holders have a 40 rupees per unit right to this income. Mutual fund aims to distribute income equally to all 1200 unit holders. This is wrong. These 200 unit holders came at the beginning of the third month, so their claim should only be on the third month's income, not on the previous 40,000. This means the mutual fund is mistakenly giving away the old unit holders' rightful 40 rupees per unit income. The mutual fund wants to distribute that per unit income to these new unit holders as well. That is wrong. Then the mutual fund tell them that look, what you are saying is right, but I cannot track when each unit holder joined because there are too many daily transactions. But I figured out another way. What did mutual fund say? Look, for example, if we wrongly deposit money into someone's bank account, we ask back for a refund from them, right? These 200 unit holders will get the total income and they will also get 40 rupees per unit because I will distribute the whole amount in the future. 40 per unit should not go to these 200 unit holders who joined later. So let's do one thing. Let's collect this 40 per unit from them in advance. We won't even have to ask for it later. Let's just collect it in advance when we issue them new units. means whenever a mutual fund issues its new units, it considers the income available for distribution up to that day. It calculates the per unit right of the old unit holders on that income, and that exact amount is collected from the new unit holders in the name of dividend equalization. Dividend equalization, 40 rupees per unit will be collected from them. 40 per unit, which means 8,000 rupees will come. So now you see, there are 1200 units and the mutual fund now has 48,000 rupees. 40,000 of income plus 8,000 from here. So if you look now, it's 40 per unit for everyone. No problem. In the third month, the mutual fund earns 20,000. All 1200 unit holders have a right to the income. All unit holders share 16.67 per unit. So in total, an income of 68,000 and the right that's established. It's 56.67 based on 1200 unit. Look at the old unit holders. They claim their full right on this 40,000 income. Divided by 1000 yields 40. 12,000 income divided by 1200 gives 16.67. Old unit holders receive 56.67 per unit. New ones only get 20,000, which is 16.67. So why give them a 56.67 per unit, right? You can get 40 rupees per unit. You have already collected it. So you took the new unit holders to whom new units were issued and equalized them with the rest of the old unit holders. Everyone came to equal level. So it's nothing, just a very simple concept. When a mutual fund issues new units in the market, it will first see what total income it has earned and the rights of the old unit holders on that income. It will calculate that per unit right and then collects that same amount from the new unit holders. It will collect that amount as dividend equalization, and when income is distributed later, everyone gets an equal share. So there is no discrimination, no disparity, and no one has any problem. Understand? This is dividend equalization. That's why we call it dividend equalization per unit collected on issue of units. It is collected, hence it gets added. I will tell you one more thing. When we talk about its accounting, although we will not learn that, suppose the NAV is 30 rupees. 40 rupees dividend equalization was collected on issue with no entry load. Issue price is 70 rupees. What is the entry? Let's say we issue 1 unit. The mutual fund receives 70 rupees. The mutual fund allocates 30 rupees per unit for capital NAV amount. The dividend equalization amount that was collected then simply goes directly to the income statement. This was essentially an income statement. It goes there. Think of it as a basket. The mutual fund stores all income for later distribution to unit holders. So dividend equalization was collected from these unit holders to distribute same amount later. So when you will collect this amount, then you should put it in the income statement. What is the issue price? From an accounting view, it goes to the income statement. Thus, we added 8,000. I have explained the concept, but for the exam, you must remember this. Look ahead, dividend equalization. Understanding the issue makes repurchase easy, and the same example still applies. Income earned first month, then second. After new units were issued, our overall fund status by the third month's end became this. At end of third month, this is the status. Mutual fund has not distributed its income even at third month's end, and it will do so in the future as is stated. As July, the fourth month's end arrived, the mutual fund earned an additional 16,000 to be distributed among 1200 unit holders, 13.33 per unit. This means total income is 84,000 and 1200 unit holders have a 70 rupees per unit right. Now after earning income for July by month's end, 100 unit holders came to me and said they want to sell their units and I should repurchase them. I will repurchase their units and make the payment. So now you know what these unit holders will say. They will tell me that you have earned an income of 84,000 so far, to which we all 1200 unit holders had a right according to 70 rupees per unit. And you haven't distributed this yet, and you will do it in future, but we won't be here anymore. But distribute it per unit to the unit holders present on distribution day. Mutual fund distributes income to unit holders present on distribution day. So you know what they will say. We won't be there on that day. So we won't be able to get this income even though our money was contributed until now. We have a right to 70 rupees in this income. We won't get that per unit. So will you not give us our money? The mutual fund said we won't take your money. This fund belongs to you all. You are leaving the company and leaving the mutual fund, but no problem. Today I am going to buy back your units, the per unit income right that you have earned up to this very date. I will settle that now and I will give the money to you today itself. I will give you all that money today itself. I will give 70 rupees per unit to 100 unit holders. This total 7,000, leaving an income of 77,000. 1100 unit holders will remain with their per unit rights till 70. Pay remaining unit holders their share. Therefore, at the time of repurchase, the full per unit right of the existing unit holders on the income earned till date is also paid immediately to them. That is why dividend equalization is paid at the time of repurchase. you have to add that per unit amount to the repurchase price. I have explained the entire calculation concept. So the dividend equalization per unit. How is it calculated? You have to prepare a statement of the mutual fund's income for distribution. The statement has 4 columns. First is particulars, second is number of mutual fund units per unit income earned and total income. You will take the mutual fund's income from the first period. So now this period can be 1 month, 2 months or 3 months. It will be clearly provided to you. You need to observe the mutual fund's first period income, that total will be provided. The opening units will also be provided in the question. You can calculate per unit income easily. You will always have to calculate the per unit income column. I have made this entire table in detail and it is the absolute crux of this topic. After this, if the mutual fund issues new units and collects dividend equalization, what is the per unit right on the income till now? Number of units that are issued will be in the units column. The per unit amount up to now, which will be just above this one. I have named this A. So the amount A will be collected per unit, and therefore to find the total, you can calculate it in the column number of units issued into per unit. After this, you will then total up the number of units and the total income. The per unit value in between will be calculated. Next month, the mutual fund earned income, so units will not change. Total income is given. Calculate per unit. Do the total. The middle column is calculated from total income and unit count. If the mutual fund repurchases units, it will pay dividend equalization. The per unit right in the actual income earned till date, which I have named B. That same B amount per unit will be applied to the repurchased units, and this amount will be deducted. Subtract the total amount for this. In the next month, the fund earned more income, units won't change as they are earning. You calculate the per unit and the total. If the mutual fund then distributes income to its unit holders, in distribution it will either tell you the per unit distribution or the total distribution. If total is given, you can find per unit by dividing by number of units. If the per unit amount is given, subtract and multiply units by that value to find total. You will do it according to the question. This is the remaining available income. This remaining income can be distributed in future. This was your entire NAV topic, where the key point and the main part was the NAV that we had learned normally. After this, the points I started with the opening NAV. There is a full detailed question for this point about which we have discussed so much. Now we will come to the third main part of this chapter, returns from mutual fund. Okay, now you have to learn to calculate. Mutual fund returns. I am an investor. I put money in a mutual fund. What did I earn from this mutual fund investment? What does return mean? As an investor, I have the absolute right to know what returns I have earned. I want to know what I earned on the money I invested. That is the return. This topic covers how investors understand their returns. And so as a result, mutual fund companies publish the returns that investors are earning from time to time. They calculate and provide how much return was given to investors in the last 1 year or 1 month. We will look at it from the investor's perspective. We will be the investors and all the questions will be based on investing money in a mutual fund. I need to know what return I have earned from my mutual fund investment. You need to calculate that return, and it is simple. The return from a mutual fund is of 2 types. An investor can calculate mutual fund returns in 2 ways. The first way is by holding period return, also known as holding period yield. Yield is a synonym for the word return. Okay, the word yield is a synonym for the word return. If in any chapter, this one or any other, when you see the word yield, just understand it refers to return. I also told you this in the basics. In the basics of FM, I told you that yield means return. Okay, yield means return. Second is annual return. We first discuss holding period return. What does return mean? It's how much money we invested. How much did we earn on what we invested, because the total amount we gained from our investment is precisely what we have defined as return, and you already know about that. So the basic fundamental of return always remains the same. We have also seen how to calculate returns in portfolios and in securities, finding them in many places. Returns names change. In portfolios, returns were known differently. Now we discuss holding period return. Why the name change? The name is changed based on the objective. There our objective for calculating the return was different. Accordingly, I explained it to you with that name in the portfolio. The return objective is different here. You can calculate returns in different ways based on the objective, but the basic fundamental of return will always remain the same. Just keep that in mind. So here, based on our objective, we want to calculate the holding period return. The holding period return. What is the objective and what is holding period return? You will understand. It's simple. Look, the holding period return. Holding period return means I am an investor and I have invested money in a mutual fund. So by investing my money in the mutual fund, I need to know what the total return I have effectively earned from the initial date of purchase until the present day. From the day I invested in the mutual fund, what return have I earned on this to this day? In terms of percentage. We always calculate it in terms of percentage. This means the total return in percentage earned by an investor or unit holder from a mutual fund throughout the period of their investment. Meaning, from the purchase date until today's date, what return have I earned? It's a simple matter. I need to see that I have invested money in this mutual fund. So what happened to my investment? So I will check how much money I have earned from this mutual fund till date. How much money have I earned from this mutual fund? From the day I initially invested my money in the mutual fund until today when I am calculating this return, I need to calculate the total return up to today's date. We call this the holding period return. For the period I have held the investment, I need to calculate the return for that total period. Let's see an example. Suppose that an investor bought mutual fund units 3 years ago. Today he wants to calculate his return and he understands he needs to compute the holding period return covering the entire 3-year investment period. What was the total return he received over 3 years? Similarly, suppose I invested money in a mutual fund 4 months ago. So for me, the 4-month return will be the holding period return. The holding period return can be different for every person. For instance, suppose an investor invested money 2 months ago, then for him the 2-month return is holding period return. If someone invested a month ago, then the 1-month return is their holding period return. Understood what holding period return is? For the total time I have held this investment, what exact return have I earned until this date? How will you calculate it? It's very easy to calculate holding period return. There is nothing to it. Let's take an example. I invested in a mutual fund on January 1st. Today is April 30th and I need to calculate the return. For me, the 4-month period is my holding period, so this is my holding period return. In my example, when I speak of 4 months of return, remember that I'm referring to the holding period return. For me, this 4-month period is the holding period and this is my investment period. So what return did I get? To calculate the return, you simply need to understand what you have earned from your investment. In the denominator, take the investment. In denominator, the formula is simple. In the denominator, write the investment value you invested. Amount invested in mutual fund means investment value at beginning. And your earnings will go in the numerator. Total yield or total profit both means the same thing. You will take this in terms of rupees or in terms of amount. You have to take it in terms of amount as investment is also in amount. What was the investment amount in the denominator and the total amount I earned for the numerator? In my holding period of 4 months, what was my total earning in this 4-month period? What are you calling earnings? It is my total yield or total profit on this investment. Multiply by 100. Why? We calculate it in percentage. It's a simple formula. So today we will analyze this formula in much more detail. And for that you need to understand the mutual fund that I had invested in was of which income plan. Dividend payout, reinvestment, bonus or growth plan. I told you it's useful. If it was a dividend payout plan. Now tell me what will be the total yield or total profit. You know the investment value, which is what you invested. Now understand how total yield or profit is calculated for the numerator. What did I earn? That's what I need to know. Then how can you find the total yield or profit? It's quite simple. What was the value of my investment at the end? Investment value at the end minus what was the investment value at the beginning. That's what I earned. It's a simple matter. Suppose we talk about shares. How do you see your earnings in shares? If you invested in a share worth rupees 100 and today its price has become 500 rupees, you say you have earned 400 rupees. We are simply analyzing the change in share price. We are looking at the change in mutual funds investment value on total basis. Otherwise we would say change in NAV. Here we do it on total basis. In questions we will do it on total basis. Investment value at end minus investment value at beginning. Plus if this is a dividend payout plan, then you will certainly also get an additional earning as well. So if the mutual fund has distributed any income to me, then I would have received it in my bank account. Any distribution by the mutual fund, whether dividend or capital gain, I would have received in my bank account, given it's a dividend payout plan. Include this, understand by example. Suppose I had invested in 1000 units on 1st January at 50 rupees, which was the NAV on that day. For now, assuming that buying and selling are happening at NAV itself. On April 30th, when calculating the return, the NAV was 70 rupees on that day. What is my return? With 70 rupees NAV and 1000 units, ending investment value is units multiplied by NAV at end, minus whatever I invested at the beginning, 1000 units at a price of 50. So 1000 into 50. This is simply my earning that my investment is now worth 70,000 and I had invested 50,000. An earning of 20,000 plus being a dividend payout plan, I received 12 rupees per unit income in my bank account. On 1000 units, received 12,000, divide by 50,000 invested. This is my return multiplied by 100. It's simple to calculate your holding period return. There are many questions. Understood? There's nothing to it. Now you might ask that why am I taking NAV in the formula here? Investment value at end means units multiplied by NAV at end. Investment value at beginning is number of units into NAV. Why are you only taking NAV? Shouldn't it be issue price or repurchase price? I assume if I sell the investment today, I will get money as much as the amount of NAV today. When the investment was originally made, it should definitely have been done at the issue price. Take the end value at the repurchase price. If the question provides issue or repurchase price, then you should use that, just like the NAV. The added note explains NAV. But there is no such question. The question always gives you the NAV. We assume the issue price and repurchase price are the same as the NAV. We assume buying and selling happens at NAV. The question doesn't give it, but it's the NAV. That's the formula. Second scenario, if the income. The plan was your dividend payout plan. If it's a dividend reinvestment plan or a bonus plan or a growth plan, then what will we do? The formula is the same. The method of calculating total yield will change. This time total yield comprises only two things: investment value at end minus investment value at beginning. This will be my total profit. Why? Because in this case, if any of these plans are there, no separate money comes into the bank account. If there's dividend reinvestment, then new units are received, bonus units are received in bonus plan and nothing in growth plan. In these cases, ending investment value, beginning investment value will be the only profit. The investment value at the beginning remains unchanged and the number of units at the beginning multiplied by the NAV at the beginning. Ending investment value is always the final unit count. It will be the initially purchased units plus units received under dividend investment and bonus plan. You have to consider, because during the period, if I have received units due to dividend reinvestment or a bonus plan, then those units will also be at end. That will be beneficial. Just consider that as well. Did you understand? Look, same example, investment of 1000 units at 50. On 30th April, NAV is 70. Dividend was reinvested at rupees 12 per unit. I've taken the same. And on the day the dividend was reinvested, the NAV was 60. So what will happen? Opening investment value 1000 into 50. That's it. Investment value at end, the units at end, 1000 units were there initially. Units issued from dividend. Dividend was 12 per unit on 1000 units. Reinvested at 60. Dividing by 60 yielded 200 extra units, making total units 1200. Multiplied by NAV at end, which is 70. So this is my profit and return. Now I took the same example. All the prices and everything are same. But here the return is 68 and here it's 64. So the return is not always the same. It's approximately. Do you understand this? Clear? Calculating returns is easy. You might be wondering, if new units were purchased or existing ones repurchased during the period, how to account for their effect? No need for that effect. New unit purchases are new investments and their return calculated independently. I sold these units and the mutual fund on the other side repurchased them. That investment is over, right? Its holding period is over. Means if I buy new units or units are repurchased, I sell them. That is a separate investment and its return is calculated separately. So don't consider that. Number of units remain constant from start to end. It could be dividend, reinvestment or bonus plans. So at the end, you have to take the purchased units and also the extra units received in dividend, reinvestment or bonus. Why are these extra units included when you said you shouldn't? I am not buying these units with money. I am getting these units for free because of that plan. That's why they are taken. Just keep that in mind. This calculates the holding period return. There's a concept called annual return or annualized yield, average yield or effective yield per annum. In mutual funds, if it was a dividend payout plan, if you see any of these specific words, all four words have the same meaning. You are calculating the annual return. This means you annualize the holding period return. Suppose my holding period return is 4 months. My holding period return is for 4 months. This is for 4 months. I want to see on a per annum basis how much I have earned. It's 64% for 4 months. So to get the annual return, multiply by 12. Whether you call it annualized yield or average yield or effective yield per annum, all four have the same meaning. Don't get confused about it. Some students think effective yield means compounding should be done. The institute doesn't do it and considers all 4 to have same meaning, so we will do the same. You calculate this. Holding period return multiplied by 365 or 12 divided by the days or months the investment was held. It's simple, take the holding period return. In the denominator, you put however long this investment was held because the holding period return is for that duration. Then you simply multiply by 12 months. If you have taken it on a daily basis, take the days in the denominator and in the multiplier, take 365. Let's say we do it on a monthly basis. Suppose we did this on a daily basis. On January 1st, I invested. Today, April 30th, I calculate return. So for how many days did I hold it? So sir, here you count the days from January to April. So 31 days of January, 28 of February, 31 of March, 30 of April, which is 120 days. Okay, so holding period return will be divided by 120 days and multiplied by 365 days. That return is the annual return. Here, due to approximation, there will be a slight difference because of the days and months. Any difference that arises from rounding is negligible. The question will specify whether to do it based on the number of days or months, or you will understand by looking at the question and the data that how this question can be solved. Otherwise, the question specifies days or months, so you don't need to think much. Now for the number of days we are taking here. So I have included the total days of January and also the total days of April. Before discussing this specific point, whenever I taught the interest calculation or teach it in any chapter, there I always used to say that you have to exclude the starting date. You have to consider all the other days except for the starting day. So here, are we taking all the days? For the mutual funds, this is the institute's assumption. In mutual funds, always include start and end dates. You must consider both days to find the number of days of investment, to find the number of days the investment is held, and for return calculation. So for return calculation, you have to consider both the start and end dates. Remember this. It is the institute's assumption that the investment on the 1st of January was made early in the morning. But if they are calculating the return on 30th April, they must be doing it at the very end of the day, sitting late at night. You have to consider both days here. Just keep this in mind when you calculate the number of days. So in the calculation of the number of days, consider both the starting date and the end date. For calculating the investment duration, remember this point. This was just the part about returns. We have solved many questions based on this in our regular class. So you can easily solve them on this basis and you will be able to revise. Now we will move on to this chapter's other topics. Part 4, that is other chapter topics. Questions are rarely asked, being useless, so we will quickly cover them. Then I will also help you revise the major specific types of questions. Look, the other topics. Evaluation of a mutual fund. Evaluation of a mutual fund means now I have to evaluate how this mutual fund is performing. We have made investments at NAV and after that we have earned the returns, but now we have to evaluate the mutual fund. You have to look at a mutual fund yourself. The mutual fund itself needs to see how it is performing. Is that mutual fund right for the people to invest in or not? As an investor, I need to see whether I should put money in this mutual fund or not. So how should the evaluation be done? We have already studied some methods for evaluation in the portfolio chapter. I had already said that a mutual fund is a portfolio in itself, and because it invests in multiple securities, it's therefore a type of portfolio. So many people apply the provisions of a portfolio to a mutual fund. That's why we've solved many mutual fund questions in the portfolio chapter. In the portfolio chapter, we learned the evaluation methods, Sharpe, Trainer's, Jensen's Alpha. These are directly used for mutual fund evaluation. We have discussed this in the portfolio chapter, but for mutual fund evaluation, specific methods exist, and the first is the expense ratio. What is this expense ratio? So it tells us that the assets held by the mutual fund, the assets that the mutual fund has. So how much of those assets are being used by the mutual fund for the operating expenses? What amount of its total assets is the mutual fund actually using to pay all its operating expenses? What does operating expenses mean? I told you that a mutual fund keeps fund managers, professionals, and consultants. Who usually manage mutual fund? They make all the decisions like which equity to invest in, where to sell, consultancy and management fee. And mutual funds also operate offices, so there are office expenses. Additionally, you must have seen ads for mutual funds on TV and in newspapers. Advertisements are not free, they also have expenses. A mutual fund's operating expenses, where will the fund pay them from? It's from the people's money, their net assets. A mutual fund is like a vault. The vault contains people's money, so some money is taken out from that money for operating expenses. So people want to know, out of our money, the money we have given to the mutual fund, that is the assets the mutual fund has. How much of those assets is the mutual fund using for its expenses? How much of those assets actually funds its operations? You calculate the expense ratio, which is the mutual fund's total operating expenses for the period. How much were the expenses of the mutual fund during the period? Divided by the net assets during the period. The net assets change daily. You should take the average net assets. Let's say my period is 1 month, from 1st April to 30th April. What was the opening balance of net assets on April 1st and the closing balance on April 30th? Dividing by 2 yields the average net assets. Multiply by 100 for the expense ratio. Look at an example. The mutual fund incurred 2000 rupees expense this period and the average net assets were 1 lakh rupees. So it means that 2% of the assets is being spent by the mutual fund on expenses. What do assets mean? I am an investor in a mutual fund. I give money to the mutual fund. That becomes the mutual fund's asset. So the money I give is the mutual fund's asset and the 2% is mostly used for its expenses. After that, it will earn and give me returns. Then I can decide and evaluate if the mutual fund is good or not. This means that the mutual fund with a lower expense ratio will be better. In practical life, mutual funds disclose their expense ratio. You can decide it accordingly. This means if I give money to a mutual fund now, the returns it will earn by investing in the market. From that, the initial 2% of the return will go towards expenses. I will have a right to the return that comes after that. So you must make your decision, and this is how the expense ratio will effectively help you in making that choice. In decision making, the next evaluation method is tracking error. Now look what is tracking error. Before understanding what a tracking error is, let me tell you a few points. There is a mutual fund, for example, HDFC Equity Growth Fund. Okay, so this is a mutual fund that invests in equity and provides growth. It does not give dividends, bonuses or anything like that. So this equity growth fund of HDFC. For this equity growth fund, managers said their benchmark return is the Nifty. If you go to the market and look at mutual funds, every fund states its benchmark return. Now what is this benchmark return? Benchmark means they have set the Nifty's return as their benchmark. This mutual fund has made the Nifty's return its benchmark. This means the mutual fund has told people in the market that they should invest their money in the mutual fund. And the return you are getting in Nifty, you know that Nifty means the market index, like Sensex. Sensex is of BSE, Nifty is of NSE, you know this. What is market index's return? The return earned in Nifty will earn and provide you that same return in our mutual fund. You cannot invest directly in Nifty anyway. If you want to invest in Nifty indirectly, then derivatives instruments are complex. Why think so much? Invest your money in our mutual fund. We will earn and give you the same return that Nifty is giving today. So we made it our benchmark or target return. Benchmark return in a way means the target return that we have to beat. We have to beat this return. So what is the mutual fund promising? They will give you the Nifty's return. This in essence is the mutual fund's benchmark return, their promised return. Now you have to evaluate whether this mutual fund is good. You have to evaluate if this mutual fund is good. So how will you do that? The mutual fund promised Nifty-like return. If the mutual fund couldn't deliver the Nifty's return, then it's not good. So you should find the tracking error. You should find the error, how far the mutual fund was from the Nifty's return. How much was the deviation, the return the mutual fund gave to its unit holders, that is its return. In the main market, this benchmark return is the market return, which can be anything. That's why I'm saying main market. What is the return from the benchmark? How much was the deviation in it? The deviation can be 5%, 2%, 10% or anything. It can be on the plus side or the minus side. Any deviation, whether it is positive or negative, means the mutual fund is making a tracking error. The mutual fund had promised Nifty's return. Now whether the mutual fund deviates on the positive side or the negative side, an error is an error and the mutual fund is not delivering its promise. This will therefore become a useful method of evaluation. So you have to find the error, the deviation. You have to find the deviation. What was the return on the mutual fund from the return on the benchmark? What was the return on the benchmark itself and what was the mutual fund's return? You have to calculate its deviation, and for calculating that deviation, the standard deviation from portfolio will be applied here. So the formula for tracking error will be the square root of the summation of d minus d bar squared divided by n minus 1. It's the same formula as a standard deviation. The standard deviation formula was the same. Look. Summation of x minus x bar squared divided by n, a slight difference to explain. What does x mean? What were the single returns in the last few periods? Minus x bar means the average return. Divided by n, which are the observations or returns as we did. Now what's in the tracking error formula? Instead of x minus x bar, it's d minus d bar. What is d minus d bar? D means differential return. We need to see the difference between the return on the mutual fund and the return on the benchmark. We need the deviation of that difference. You need to calculate the differential return first because it's the mutual fund's return minus the benchmark's return. Calculate the differential return if evaluating for the last 5 years computed for that period. Averaging this gives d bar. That's it. Now its standard deviation is the summation of d minus d bar squared divided by n minus 1. Standard deviation uses n while portfolio uses n minus 1. Now the rule of statistics. The rule in statistics states that if there is sample data or some limited data, you subtract 1 from the observations to calculate standard deviation. And if there is the entire population, then you can divide by n. So our institute is great, as I've told you. In the mutual fund chapter, the institute assumes its sample data in questions. So it does n minus 1. In the portfolio chapter 2, we have sample data in the questions, but where does the institute understand this? So for the portfolio chapter, you will divide by n. To calculate mutual fund tracking error, divide by n minus 1 and the reason. To calculate this, I have an example for you to understand questions based on this. Similar ones are often formed. The year is given, the return on the mutual fund in the last 5 years and the return on the benchmark it was following. First, I calculate the differential return. Mutual fund return minus benchmark. This differential return, I got the data for D, average it. So D bar, which gives D minus D bar, then square D minus D bar, which I have done. D minus D bar squared divided by n minus 1. Under root gives tracking error. I have calculated the normal standard deviation tracking error is complete. This means there is a tracking error of 2.272%. Do you know what this means, this mutual fund? It deviates by 2.27% in its return. Relative to the benchmark return, it's 2.27% more or less. This is what it's indicating. Understood? After this, next topic. Return that a mutual fund should earn so that an investor will be indifferent on direct investment through the stock market or indirect investment through the mutual fund. What does this topic say? So this is not a topic, it is a normal mathematical point. You should know this. It's a very basic point. Let me explain. What does this point want to say? A mutual fund. How much return does it need to earn? How much return does a mutual fund need to earn to give an indifferent return to the investor? So that it can give an indifferent return to the investor. Indifferent means whether the investor invests directly in the stock market or invests indirectly through a mutual fund, he should get the same return. You will understand better with an example, so listen. There is an investor who is investing directly in the stock market and today he is earning a 10% per annum return. We do our analysis on a per annum basis. Per annum he earns a 10% return. I suggested to that investor, why face the hassle of direct stock market investment? You should invest indirectly through a mutual fund. The mutual fund will earn returns for you. You don't have to do any analysis, give any time. There is no problem at all. So what will the investor say? He will say, your point is valid, but I will invest in a mutual fund only if this fund can give me a 10% return. Meaning I'll only invest in this mutual fund if you can successfully get me the same 10% return from it that I'm earning from the stock market. His first question will be, can this mutual fund provide the 10% return that I am already earning from the stock market? Meaning, how much return should the mutual fund earn to make the investor indifferent, so that it doesn't matter to the investor whether he invests directly in the stock market or indirectly through a mutual fund? That investor should face no problem. Because let's say if this mutual fund gives only a 9% return, he will prefer direct investment, saying that it takes effort but the returns will be higher. So the mutual fund wants to know, these mutual funds keep updating themselves from time to time. The mutual fund will check daily, it will keep checking the scenario from time to time to see what return investors are getting in the stock market today. So the mutual fund will see how much I have to earn to give these investors this stock market return means 10% return. I mean the mutual fund itself, how much will I have to earn? To give 10% to investors, mutual fund must earn more. It's not simply 10%. If mutual fund gives the investor the exact return it earns, then what will it live on? It has the expenses like fund managers and it needs to cover them. The mutual fund must earn more, so we need to calculate that. How much does the mutual fund itself need to earn to give the investor a particular return? So it's very simple, understand. How much do we have to give the investor? It's 10%. If nothing written, 1 is in the denominator. If we talk in mathematical terms, it means there is a 1 in its denominator. So what does this mean? If an investor invests 1 rupee, I must earn and give him 10% return. If that investor puts in 1 rupee, then I must earn and give him 10% return. And for the larger sums, we pay proportionally. But there is a twist here. Initial expenses in the mutual fund will be deducted from 1. What is this? So look, The investor invests 1 rupee into the mutual fund. However, when it reaches the fund, it will then decrease, becoming 95 paise. So tell me, how can this happen? I had given you an example in class. Once Modi ji said that the government from its own side issues 1 rupee for poor people so they can effectively and directly get full benefit of this 1 rupee. But by the time it reaches the poor, that 1 rupee becomes only 20 or 30 paise because there are many middlemen in between, corrupt people who pocket the money. Yes, wherever there are middlemen, they will certainly take a cut. This exact thing happens in a mutual fund too, and I will explain. In a mutual fund, one way is to go directly to its website or any trading platform that I previously mentioned, popular ones like Zerodha, Grove, Upstocks or ET Money. Go to any trading platform, it will directly link you to the AMC's website for mutual fund investment, because mutual fund units are bought and sold directly from the AMC. This direct investment in a mutual fund is therefore called the direct plan. This is the mutual fund's direct plan, clearly written on it, and all online investments in mutual funds are made through these specific plans. Now the same mutual fund also issues some regular plans. What are regular plans? You won't easily see those plans on website, as those specifics are given directly by mutual fund to its distributors, brokers, agents known as the middlemen. Those broker are generally banker. Sometimes you will see banker coming to your house. They will say, sir, please invest in this mutual fund. You will get good returns. So you will tell that banker that, okay, invest 1 rupee in this mutual fund on my behalf. So as soon as you give him 1 rupees, that banker will deduct his commission from it. Suppose his commission was 5%. 5 paise will be deducted by the banker, and then the remaining 95 paise will go to the mutual fund for your market investment. And I'm sitting here thinking it's my 1 rupee. Middleman presence defines regular mutual fund plans, okay, which you can invest in offline through distributors. This is done when people have no knowledge of investing online or when they genuinely need suggestions. And in a regular plan, the distributor also suggests where you can typically gain more returns, so you choose it in that scenario. Did you understand this point? This formula generally applies to regular plans, because a normal direct plan leaves nothing in this formula. I have to earn 10% return for my investor on 1 rupee. No, that's not quite right, and it's not on 1 rupee. There was a middleman in between. There was a middleman who collected 1 rupees from the investor and is giving me 95 paise because his 5% commission was fixed, which I had told the middleman that you bring the customer investor and I will give you a commission. So I have only received 95 paise in the investor's name. So now I have to earn 10% for the investor on 95 paise because that investor wants a 10% return. Understood? So 10% divided by 1 minus, we will have to deduct the initial expenses, which were 5%. So I have written 5% in decimals, that is 5 by 100, which is 0.05. Okay, no problem. I have to earn 10% return on 95 paise for investor. Is that enough? No. Apart from this, I have operating expenses and an expense ratio. These represent my costs that occur in every period. The mutual fund needs to earn that expense as well, and these are called annual recurring expenses because we calculate them on an annual basis. So the annual recurring expenses of a recurring nature, that is operating nature, in percentage terms, I will have to earn those as well. So what then is the formula? This total amount came to plus my annual recurring expenses of 2%. So in total, I will have to earn 12.53% to give the investor 10%. Let me cross verify it for you. I will earn 12.53% myself. 2% will go towards my expenses, that is my annual expenses. How much return will be left? 10.53. But this 10.53% is according to 95 paise, not according to 1 rupees. The investor thinks they invested 1 rupee, but I only received 95 paise. Therefore, the 10% return based on 95 paise will give them their 10%. So you have understood how this formula was made, and it is really simple. To calculate this, you must take the investor's direct stock market return. How much is he earning already? Divide by 1 minus the mutual fund's initial expenses, plus annual recurring expenses of the mutual fund. This is the return which the mutual fund needs to earn for investor indifference. Let's move to the final topic, that is hedge fund manager fee calculation. Understand this topic. Now all of you look, fee calculation of hedge fund manager. So we can first, let's talk about hedge funds. What is a hedge fund? A hedge fund is a type of mutual fund. A hedge fund is a type of mutual fund that is less regulated compared to a regular mutual fund. A hedge fund is structured like a private entity, whereas mutual funds are typically formed as trusts, and this is generally registered in the market as an LLP. And it does not reveal any of its confidential information like its daily operations. So what is this hedge fund and how does it actually work? If I talk about it in more detail, then let's take the very same example I gave you in the regular lecture. As a chartered accountant, I have seen that there are many mutual funds in the market and they are giving very low returns. I feel that I have enough intelligence that I can very easily earn a 40% return for my investors today if I were to start a mutual fund business. These mutual funds are giving no returns and I can earn a 40% return for my investors. I have that much intelligence. I thought so. I felt that I should open a mutual fund business. So I want to open and set up a mutual fund business. If I can earn such high returns, investors will come to me. But I have one more thing. If I can earn such high returns, it means I have special knowledge, and I don't want to make that special knowledge publicly available. And it is because mutual funds have to disclose which security they are investing in, what percentage, what is the NAV, who are the fund managers, how they work. They have to make everything publicly available for mutual funds. Because the government regulates them well. The government says it's a trust, it's a common pool of money. So investors and the public should know everything about the mutual fund. That's why they have to make everything public. As a chartered accountant, I know how to successfully make money from the market, clearly understanding which shares to invest in. You see, when I clearly know this, I feel that I will invest in certain shares. I'll take a long position. If some share prices fall, I will short sell and take a short position. So by doing this, I can earn a 40% return. But I don't want to tell the trick to people about how to earn a 40% return in the market. Because if I open a mutual fund and have to make everything public, and if I make all the information publicly available, if such return is there, who would then come to me? I don't want to share my trick. If I know exactly how to earn, then why should I tell everyone else how I do it? If I tell people my money making trick, then that's wrong, isn't it? The government accepted your valid point, then said, do this. Start a hedge fund. Create a hedge fund. In a hedge fund, we remove many regulations, meaning you don't need to publicly disclose information about your operations, because what happens is it is functionally quite unregulated. So I will set up a hedge fund. I will not tell people anything. So what I will do is tell the people that I will earn them a 40% return, but I will not disclose what I invest in or which stock I will decide to short sell. Normal mutual funds can, however, only invest in long positions within the market. In a hedge fund, I can earn returns for people even taking short or diverse positions. So I can do all these things in it, but I don't disclose my operations like which company's shares I'm going to buy, which companies I'm going to sell. I don't give any such information. So I register it as a private entity and then create a private business like an LLP. I will not reveal anything about my operations in this. When I don't reveal any of my operations, the government says that in this case, they will impose a restriction upon you. You cannot advertise your hedge fund to the public. Because you keep operations private, if you commit fraud, who is responsible? So a hedge fund will never put an ad on TV saying, look, I am a chartered accountant with more intelligence. I have so much intelligence that I can earn a 40% return, which no one else in the market is earning. So you should come and invest with me. I cannot give such an ad. Neither can I give an ad in a newspaper, nor can I distribute pamphlets. As a hedge fund, I cannot advertise my impressive returns, nor can I invite general public investment. This means general public doesn't come to me because they don't even know such a thing exists. So then where will I get clients, customers who will invest in me? They say you should find them through your network. If you have the intelligence, then build a network. Go to your friends, tell them. Suppose I had a friend, I told him come to me. Give me 10 lakh rupees, I will invest it. I will earn you a 40% return. But I won't tell you my process, but I will earn it for you. So build your network and develop confidence. Make people believe and trust that you can earn great returns and they will give you their funds. A hedge fund is a private business. So I bring clients in one-to-one. So this is a hedge fund. So in this, my clients are selected. So I promise high returns to selected clients. So since my clients are selected and I am promising high returns, I also want to charge a hefty fee. It's a simple thing. If I'm putting in so much effort, I will charge a hefty fee. The hedge fund manager, the chartered accountant. I will now manage this fund. So it's a hedge fund. Then I become a hedge fund manager. So a hedge fund manager calculates two types of fees from his clients. I charge fees in two ways because I have to collect a hefty fee. Normal mutual funds calculate and deduct their fees and everything from the net assets of the mutual fund itself. It's a common fee for everyone which they calculate and take out. They don't take fees separately from client to client. But in a hedge fund, I am bringing in clients one-to-one. I bring clients one-to-one, then my fees will certainly vary by client. I make a contract with the client about how much fees I will take from him. First, I earn client returns, then charge fees. This method is different. This is a direct kind of private business. And how will you take the fees? Fees are charged in two ways. First, a base or fixed fee. This is a fixed percentage of the assets under management, which you also call AUM in short, asset under management. Portfolio of client. There was a client and he gave me 10 lakh rupees to invest in the market. So he gave a portfolio of 10 lakh rupees of assets to me to manage. So his assets under my management are 10 lakh rupees. I told him I will take 1% of the asset under management, meaning I will always take 1% of 10 lakh as fees from him. I will tell him whether it's 1% annually or monthly, okay? I will fix that. It's not like I'm taking 1% every second. A deal will be made. Assuming we are talking annually, I will take 1% of 10 lakh rupees for sure. Regardless of whether his portfolio, that is his investment, the amount I have taken from him, which I have invested in the market, whether it has a positive or a negative return, meaning whether I've decreased or increased the value of his 10 lakh, it has nothing to do. I'll definitely take a 1% fee from him. This fixed fee covers my effort and is taken even if the market investment value falls. This is fixed, it's normal, no problem. After this, the second fee I will take is an incentive fee. An incentive fee is a kind of condition-based fee which is linked to the fund's performance. I tell the client, you give me money, I am earning you higher returns and I want a higher fee. So for that, we keep a provision in the contract with the client. I can give any condition to the client. What could this condition generally be? Let me give an example. It can be any condition. Suppose our contract states the client's managed portfolio value is 10 lakh rupees. If it goes above a particular level, that is, you need to understand here, if that portfolio goes above or beyond a particular level, then however much the portfolio increases above that level, then what will happen is, I will collect a fixed percentage of that as an incentive fee from the client. I will explain with an example. I took 10 lakh rupees from the client, the fixed fee was 1%, so I'll take 10,000 rupees, it's for the incentive fee. That if the client's portfolio of 10 lakh, if I take it above 12 lakh, if I take it above 12 lakh, meaning I earn him a very good return. So if the value of his portfolio goes above 12 lakh, then however much its value goes above 12 lakh, I am going to take 10% of that excess as an incentive fee from the other party. So suppose the value of his portfolio reached 15 lakh. I worked in the market in such a way that his portfolio reached 15 lakh. It exceeded 12 lakh by 3 lakh. And then 10% of that 3 lakh will be collected as a 30,000 incentive fee. This means this is a condition based or performance based fee. So if it performs well according to the condition decided in the contract, then this fee will be received, otherwise it won't. The condition can be anything. So what it generally is, I have noted here. It is charged only if the value of the portfolio increases above a particular level as decided in the contract. An incentive fee percentage on the portfolio's excess value. This was your topic. It was a simple topic. It's equation which we did in the class. And you got the complete idea as well. So I have revised all the concepts of mutual funds for you. So after revising these concepts, you can easily go through all the solutions we did in detail in class. Now you should revise them. First read the notes and look at the questions from the question bank and revise from the detailed solutions we wrote in class. Otherwise, if you look at the question bank, you won't understand anything. We understood and solved questions and you have practiced them. Revise from those solutions, there's no problem. And now for some specific questions, because this is a question based chapter, I will quickly revise the specific points in those specific questions for you as well, so that there is no problem. Since this lecture will also go on YouTube, the students also have unnecessary doubts in those questions. Those will also be cleared. This was taught to you conceptually in class. For those who haven't studied with me, for those people, I will explain this specific question point. You all often find those points difficult. I'll only talk about specific questions. Firstly, in question bank, we talked about net asset value of mutual fund. Our question bank is bifurcated topic wise. I always arrange the questions topic wise in sequence, and in class we also cover them from 1, 2, 3. It's not like I just compiled them like others, just putting questions together anywhere. We arrange them topic wise from easy to hard, so that if you are studying on your own or revising, you don't face any difficulty. It is made accordingly. That's why its name is a question bank, not a compiler. Some students are special. I will clear up their doubt as well. What's their issue? Some students don't want to study chapter modules. Their job is to compare, and they pick up others' question bank. Or they will pick up the module and then ask, module question isn't in your book. So when you compare them, do it properly. That question, whatever topic it belongs to, I arrange that question in that topic of that chapter. These valuable questions are not simply compiled, but crafted with effort. Making this takes time. Compiling means copy paste, and this isn't copy paste. A lot of effort is involved. So when you compare, see which topic and which chapter it belongs to, because the institute sometimes puts it in any chapter. And others' job is just this, just add it wherever it's placed. They don't even know what's going on in which chapter. It's all just up in the air. They upload videos and you're happy thinking, great question solved. They're just fooling you and you don't realize. Alright, let's move forward. I'll highlight specific points within the questions, focusing on the unique ones. Look, this is one question that has a specific point where most mistakes are made. Here doubts arise for students who haven't studied with me. Endline states other fixed interest securities are valued at cost. The question clearly states to value other fixed income securities at cost. So now don't use your own logic thinking that there's market value, so you'll use market value. So whatever the question says, that will be done. Statements in the question supersede everything. The question said to take other fixed income securities at cost. So completely ignore the market value given. It's of no use, you have to value it based on this. Just keep this in mind. Removing this line, then we would use market value. Someone might even have this doubt, if I hadn't mentioned this line, they'd ask, sir, what would we do if this line wasn't written? You see, such doubts also come up and I don't like them, so what can I say? For the final level student asking this doubt. So if doubts arise, then I must explain them. Look, after this, a doubt generally comes up in this question. Listed bonds are provided. Their cost from investment was 24 crore rupees. We purchased 16,000 bonds, each for 15,000 rupees. The bond's coupon rate is 14%, meaning its interest rate, which we will receive. About this for you. A market expectation on listed bonds is given. Now what is this given for and what's been done? We've studied this in security valuation, take it at market value. How is it the market value? To find the market value, it's simple. This is your yield to maturity, which represents the market's expectation for these bonds. This means if you calculate the present value of the bond's future cash flows using the YTM, you will get today's market price, the market value of the bond. For this bond's PV, the future cash flow is interest. And redemption amount, it doesn't say when it will be redeemed, what will happen, or at what amount. Let's assume it's an irredeemable bond. When nothing is mentioned, you cannot assume it will be redeemed in 2, 4, or 5 years. Don't make unnecessary assumptions, that's your responsibility and I can't do anything. If we don't make pointless assumptions, it's an irredeemable bond, never redeemed. Only interest will be received. The bond's 24 crore cost implies its face value with no other investment details. Because all these assumptions, I've taught all these things in security valuation, this point is from there. Other chapter concepts are mixed in, nothing special. 14% interest will be received. This is the amount you will get yearly for life. PV for lifelong cash flow is perpetual cash flow divided by discounting rate, 8.842%. Present value and market value calculated. This was a special point. Question's second point. In this question, cash and cash equivalent are given and the expenses incurred by the management by the fund are also given. So the cash amount is also given. Expenses are given. Shouldn't we adjust these to find the closing cash balance? What did I say? Calculate closing cash balance only if not given. Here cash and cash equivalent is directly given. This means the cash balance is given to you. The balance given is the closing balance. These expenses are only to confuse you. Ignore them and take this balance directly. Remember, if it says cash and cash equivalent or cash in hand, it's always the closing cash balance. As final level students, having studied accounts, understand this closing cash balance. Why adjust expenses? They're already adjusted. Got it? So this is a special point, meaning this was given in question to confuse you. They won't be of any use. I told you the points of this question. Let me explain this question once. What did we do in question number 9? In question number 9, on a particular day, the NAV of two mutual funds was given D and K. NAV means net asset value per unit, and what is the net asset in a unit? Then the net asset value is 99% equity and the remaining balance left is the cash. For K's mutual fund, the net assets were explained as bifurcated and shown. The net asset of one unit is given, so we'll assume the same. This is total net asset. The total net asset is bifurcated with 99% invested in the mutual fund's equity shares. The remaining 1% is cash, similar for K's mutual fund. Sharp trainer and the standard deviation for both the funds are given. You find the expected NAV for the next month. Now, if you have to find the expected NAV for next month, it's mentioned that the mutual fund's annual cost is 3 rupees per unit. Since all data is per unit, the average annual cost is 3 rupees. To find the next month's expected NAV, we calculate the next month's net asset. We'll find next month's cash balance. Next month's cash balance is 3 rupees for the whole year divided by 12. So we found out the cash expense for 1 month. If you subtract that, you get next month's cash. Similarly, you are told the stock market will fall 5% next month. So if the stock market falls by 5%, what change will occur in the shares, the equity shares in which the mutual fund has invested? For that, you need the beta of that particular investment in equity shares. Beta is calculated using formulas. Calculate it using Sharpe ratio data. Expected return minus RF divided by standard deviation. So you got expected return minus RF. Put the expected return minus RF into the Treynor ratio and you will get the beta. Once you get the beta, you have the beta. Whatever beta comes, it will be 1.5 in this case. So beta is 1.5 and the market is falling by 5% means 7.5%. The investment in shares within the mutual fund will decline. By next month's end, we've determined the equity share investment and the cash balance. It's the next month NAV. Look, let me show you the solution I provided. The solution we did, I'll show you for one mutual fund. There are two questions in it, D and K. In D mutual fund, today's NAV is given, split, 99% equity investment and remaining cash. This reflects the fund's net assets bifurcation. We need to see the cash balance after 1 month, and today's is this. What will be 1 month's expense? Annually 3 rupees, so it is this. The cash balance left. Calculate the equity shares amount for next month. For the change in the equity shares, you'd need the beta of those shares. Sharpe ratio yielded ER minus RF. ER RF with Treynor ratio calculates beta. The beta is 1.5. The market will fall by 5% next month and your present equity investment will be this much. If the market falls 5% next month, shares will decline by 1.5 of 5%, totaling 7.5%. This becomes your next month's NAV. The month-end equity shares investment balance and cash balance after 1 month. How easy this question is. It looks like some strange question, but these questions are very easy. After this, the special question I mentioned, for income available for distribution, you have to use the same statement. No further explanation. Let me explain one more specific question in which people don't understand in this chapter. This chapter has limited concepts, but the questions the institute creates are different types of reverse calculation. This question involves a mutual fund which declared a 9.98% dividend reinvestment plan. If a dividend is declared, then it's reinvested and units issued. 31st March 25. And the investor who is there? The investor was given additional units and they were issued at the closing NAV. Closing NAV is 24.95. The investor who invested in this particular mutual fund, he possessed 20,800 units when the year ended. And he had invested in the units before the declaration of the dividend. So whatever he invested, he would have been issued new units according to the closing NAV for the dividend he was entitled to. And the investment was originally made at the opening NAV at that time plus the entry lot. The NAV during the year, in this period, the NAV has appreciated by 25%. It has increased by 25%. The unit's face value is 10, used when the dividend percentage is specified for mutual fund distribution. Fund distributes on face value. Remember, mutual funds always give dividends on face value. You need the opening NAV. To calculate the opening NAV, you must consider the data provided. Closing NAV 24.95. You are told that the NAV has increased by 25% during the year simple. Did we do this? Opening NAV plus 25% gives the closing NAV. So the closing is within this. We had to add 25%. So you can find the opening NAV as a balancing figure using mathematics. In basic mathematics, I will first teach you basic mathematics in FM. Alright, in AFM, I first taught you basic mathematics. So apply that basic mathematics, you'll get the answer. I have taught how to solve calculations and equations completely in it. I always teach you from the basics in every subject, so everything is covered in those basics where you might get stuck. It also taught solving equations. So when we did the question in the rest of the class, we discussed that thing again, but I'm not explaining all that now. I told you in the class. Now second part. How many units did you purchase? Today, the closing units are 20,800. So how did the closing units come about? The opening units which I initially purchased plus the additional units I received through dividend reinvestment equals 20,800. So I will assume the opening units I purchased as X. Then you make the equation. I had X units. The additional units received in dividend reinvestment will equal the closing units. So X plus. Dividend reinvestment units should equal what? 20,800. These types of questions can only be solved by creating an equation. You have to use your brain and have to practice. We have practiced in class. Now you use your brain, work hard. Alright, look in this, the additional units. How will additional units be calculated? There's a simple way. How will you get them? According to the dividend declared today, the dividend is declared on the number of opening units, which is X. You will multiply by the face value and the dividend. This is the amount of dividend. This would have come into the bank, but instead of coming to the bank, I received it in the form of units. How did I receive it as units? The dividend was reinvested at the closing NAV as is stated. So divide by closing NAV. So you'll find the additional units. So solve the equation accordingly. You will find how many opening units I initially purchased. So what was the initial investment amount? So I invested at the opening NAV plus the entry load. The issue price is this, then what you can do is multiply it by the units purchased to get the investment amount. It's very easy if the concept is clear in your mind. That's why the concept notes I give you are final. Memorize them. I always say first that they are the most important thing. You must remember concept notes. Some students have a habit of only solving questions from question bank. Wherever you are studying from module, you sit down to do those questions. You ignore the concepts, only practicing questions, and watch a video solving one, thinking it's great work. The question alone does nothing. As soon as a question like this comes, you'll say, paper was out of the box, how will we get marks? And I'll review, stating the paper was normal, then you'll feel something else. You'll feel bad about how I said that, because I know, right, according to what I teach, it can be hard. What I have taught in class, if you review previous papers now, and then solve those questions, you will surely find them easily solved in the very same way. But what mistake did you make? You just rely on the questions, you memorize the questions and go. You find a video of a question, let's watch this. That doesn't help. Understanding the concept is key, and with it you can solve any question. New questions are solved conceptually, and existing ones also with concepts clear, because my notes give you the full format and all the steps. If you apply those, that question will be perfectly correct. There will be no chance of mistakes. That's why they should be fixed in your mind. If the concept was fixed in your mind now, you would know that, okay, we can apply it this way in this topic. So that thing will definitely work for you. Look ahead, anything else? The specific questions in it. Look next, this is a specific question in the return section. There was a topic on returns. We first looked at calculating returns. This was a unique question. In this question, in the topic of returns, mutual fund returns, dividend, bonus, and growth plans. We did questions on calculating normal returns, solved directly from your notes, there's no problem. After those questions covering the bonus, dividend, and reinvestment plans, we calculated the return. It was normal, no problem. But there's a special question in this. It's the same on dividend, reinvestment plan, and bonus plan. Everything is given to you, returns, etc. are given. You are only asked that when the investor initially invested the money. What was the NAV on that day and the issue price? At what price did he invest? This is a reverse calculation question. No new. Separate notes are needed, as the same concept from your return notes applies. If that is just fixed in your mind, that's why I say the concept notes should be fixed. This question will be solved very easily. I'll revise it for you now. Look. For dividend reinvestment, you are given when the dividend was distributed and also at what percentage it was reinvested. For the bonus, what ratio is distributed? NAV for the dividend investment plan and the bonus plan on different dates. Additional details for dividend and bonus plans are provided, including investment amount. Then the average rupee profit from the dividend reinvestment plan. It is given. The bonus plan's average percentage yield is provided. Face value given, issue price sought 1st April 20. The last NAV on 31st March 25 is given. This implies the investment was concluded. Then what return would you get? This will also be on this. To find the opening NAV in this question, how do we calculate it? For that, you must really take some time to think about how it can be found. Is the opening investment given and how much I invested? Yes, then think about additional details. The additional details, those come in handy. In such questions, the additional data the institute gives, you should understand that data is given for this calculation. Such questions solved using additional details. You just have to understand it. So let's talk only about the dividend reinvestment plan for a moment. The total invested amount was this much. How to find initial investment amount? For dividend reinvestment, the holding period return formula is and investment value minus beginning investment value divided by beginning investment value multiplied by 100. The formula for investment value at the beginning is the number of units initially purchased multiplied by the NAV at the beginning. So here I know the investment amount, but I don't know the exact units at the beginning. Knowing the beginning units would instantly simplify the NAV calculation, and then the question becomes a quick 2-minute solution. What would I do? I would divide this amount by the number of units I received at the beginning. Done. But I don't know these units at beginning. So in this question, find out how many units I had at the beginning. If you find that, you will get the NAV at the beginning. So how do I find the beginning units? Is there a way? There doesn't seem to be a way. Now within the additional information for the dividend plan, the average profit in rupee terms is provided. The average profit in rupee terms is given. It's for our calculation. How? Now think. Average profit means what comes in the numerator of formula? Total profit. Investment value at end minus investment value at beginning is the holding period return formula, because this calculates the total profit you have earned in the entire investment period. So what does average profit mean? Just like when you average the total return, holding period return, you call it average return, average yield, or annual return. Meaning you annualize it, so you call it average yield or average return. I've written this in the notes. Similarly, the total profit in the numerator must have been averaged on a yearly basis. Well, in 5 years, whatever total profit I earned in this investment in 5 years, the total profit is in the numerator and it must have been averaged annually. So we called it average profit. Understood? This means that the profit which I have earned from this investment on an average basis for every single year is clearly given. The total period is 5 years. This is determined by considering the investment and closing dates. Calculate it, it's 5 years. So how much profit I must have earned in a 5-year period? That will be my total profit for the holding period. So let's calculate that first. Now you see. Investment is 5 years. It's the average profit. So total profit earned in 5 years is this much, which means I received this yield in rupee terms in dividend reinvestment plan in 5 years. The total yield is known. Total yield or total profit. Total yield or profit is investment value at end, investment value at beginning. From this you can calculate the investment value and the total profit. Given the beginning investment value, the ending value can be derived. I am applying concepts directly from the notes, and these questions require referring to them because everything is written there. You need to identify the topic applied in the question. And after that, remember the things from notes, like the data is given in the question. From that, there was this thing in the notes, you can calculate this. Then you can calculate this and then that, and from there you can proceed with the questions. Always use the given data, converting the average to total profit. From total profit, use its formula to get an investment value. Concepts are essential, remember. Notes are the most important thing, and I always say questions are just for practice. The investment value at the end you have. What about this investment's final value? So investment value at the end was the value of my investment on 31st March 25, that is known. 31st March 25, dividend plan NAV also known. So divide by this NAV, you'll get number of units at the end, because what formula for investment value at the end I've written down and made you write. Number of units at the end into NAV. So number of units at the end for 31st March, we calculate number of units. Meaning the closing units. When my investment ended, the closing units that I had was 21,607 units. This has been found out. Closing units found, but opening units needed for NAV. From these closing units, you can find the opening units. Consider how. So how did these 21,607 units come about on 31st March? In the starting as an investor, when I bought the units, I received a 12% dividend and new units were issued to me through reinvestment. This is the closing of that day. Plus then next time I must have received 10% units on that. Then units at 15%. Since they're similar, a reverse calculation is needed. How did 21,607 units close? Last dividend was 31st March 24. So on 31st March 24, the closing units would be 21,607. Same that's left today, as after this no dividend was ever received. For March 24 opening units, we assume it as X. X plus on 31st March 24 additional units from dividend. Calculate X plus the additional units received. Number of units X on that day multiplied by face value of the unit, which is 10 rupees. How much dividend was received on this day? 15%. Divided by the NAV on that day, which was 45. These new units are issued. So the total units for today is 21607. Solving for X from this means you found out how many units were in the opening on 31st March 24. You'll calculate March 24's opening units. Opening units mean the closing units of 31st March 23. It's closing unit. Apply this calculation for closing units. March 23's closing units are 24's opening units. For March 23's opening units, assumed as Y, add that day's additional units. Then solve for Y. The opening of this day means the closing unit of the day the dividend was last distributed. I considered opening as Z and use it for closing. Calculation. Your opening units came out to be 20,000. Since no other dividends were distributed previously, these must be your originally invested units. The initially purchased units and initial investment amount are given. Calculate the NAV at the beginning as the issue price was asked. It will be solved in the same way for bonus plan case. I taught you this in class. This was the specific question I asked you. I've revised it. There shouldn't be any problem. Everything is normal. After this, look at question 25 as well. Another special question, a reverse calculation. On 1st July 2022, Mr. X invested in a mutual fund. On that day, 10,000 units had a face value of 10 rupees and the investment was made at that price being the initial NAV. He invested 10,000 units, an investment of 1 lakh rupees. On 31st March 23, the fund declared 10% dividend. Mr. X found that his annual yield for this year is 153.33%. My investment period was just 9 months from 1st July to 31st March. 9 months, what's annualized conversion? We go to holding period. Next year, 31st March 24, mutual fund distributed 20% dividend. In the next year, on 31st March 25, I redeemed all my units, including the 11,296.11 units left in my balance. This was my annualized yield that day. Now you must find each year end NAV. Now look at this question. Which plan is it? It's about dividend, so it must be dividend payout. Nothing is mentioned about whether it's dividend reinvestment or something else. So this is dividend reinvestment. So how did you know? It's easy to determine since I invested 10,000 units initially. You might think the institute omitted information or made assumptions. Not so. You will have to use your mind. Starting with 10,000 units. When I was redeeming the units, I had 11,296 units. In between nothing. Did I purchase any new units or anything? Then how can the units increase? I received dividends, so they must have been reinvested. You realize this? It's a dividend reinvestment. Then you have to find the units. How will you find those? Firstly, you have to find the NAV at the end of each year. So first let's talk about the first year. The data up to here is for the first year. I invested 1 lakh rupees, 10,000 units at 10 rupees. Its face value is also 10 rupees. On 31st March, this mutual fund reinvested a 10% dividend. And I found out that I got an annualized yield of 153.33% this year. So can I first go from annualized yield to holding period yield? For 31st March, convert annualized return to holding period return. What was my investment period? Just 9 months. I wrote annual return formula. Calculated holding period return using data from annual return formula. Always use given data. Because you cannot calculate from the annual return if annual return is given. Go to the holding period return. The formula is for holding period return. Annual return derives from conversion. Now let's look at the holding period return and you know its formula. The holding period return is known. Beginning 10,000 units at 10 rupees and that is 1 lakh. You can find the value at the end which is 2,15,000 as of 31st March 23. This value. How's value at end calculated? Ending units multiplied by end NAV. Are both these things available to you? Neither is available. We don't have the number of units on 31st March nor the NAV on 31st March. So what do you have to do now? We will create an equation from this and then calculate both things. Let me assume for a moment that NAV at the end is X. We write it in short form so there is no problem in calculation. We will find the number of units at the end. So how will that come? How many units did I have at the start? 10,000. Plus I would have received additional units due to the dividend. How many? It's 10% dividend. So 10,000 units into 10% dividend. What is the face value? 10 rupees. Rate at which it got reinvested. So dividend was declared on 31st March. The NAV of 31st March assumed as X divided by this. So this is my total units at end multiplied by NAV at end. What is that? X. So I got my investment value at end. You have to create an equation like this. There's nothing special. The equation in the formula. Create an equation and then solve it to get the ending NAV. Now that you have the NAV, you can check how many additional units you received. So you have found out that on 31st March 23, these are the total units. Understood? Now come to the next year. The calculation for the next year is easy. For March 24, only one detail is provided. A 20% dividend was given. And there is no other information, so 20% dividend reinvested. On March 24, opening units equaled previous period's closing units. We calculated this. Plus you would have received additional units. Additional units are derived from opening units times face value and dividend rate. Divide by NAV assumed as Y, 31st March 24's unknown, yielding closing units. We calculated these closing units. I know, look, how do I know? On 31st March 25, unit balance was this much. This means that after 31st March 24, the mutual fund did not distribute any further dividends. Means the units would never have changed after that. Closing balance on 31st March 24 would have remained balance later. Means this total balance is closing of 31st March 24. Understood. Solve the equation NAV for 31st March 24. Last 31st March 25. Annualized yield became 73.52%. To find NAV, first convert this into annual return. So how much time has passed since 31st March 25? It is 33 months. I invested on 1st July 22. Calculate the 33-month holding period return. In the formula, holding period return derived yielding end value. The value at the end is here. You multiply units at the end by NAV at the end to get that value. Units at end 11,296.11. Find the NAV at end. It's complete. How easy this question is. There's nothing to worry about in it. We have revised the entire question. You can see that the solution uses the same calculations as we did. It's just presented differently. So if you look directly, you won't understand. That's why those who have taken the class should prefer the class solution. If you revise with that, your revision will be perfectly smooth. Alright, the calculations I teach and the systematic methods I make sure you follow. With these exact methods, your answer will thoroughly match the institute's official marking scheme, and then you will get full marks. If I wanted, there were other shortcut methods I could have taught, like how people get the answer in 2 minutes. But you won't get full marks. If it's for 8 marks, you'll only get 2. Then you'll say institute is biased and doesn't give marks. That happens because you are following wrong method. Follow the institute's complete method. I know what things are marked. Now you'll say this theory and line is written. Are there marks for this too? If you start looking at this wording, then nothing can be done for you. You'll just keep cramming this. There are no marks for these. I have told you 1,000 times in practical subjects. They have marks. Even among them, some special figures that I know, those have marks. So in my calculation, I take all the figures. According to that, I make you write steps in our class. That's it. These were some special questions that I have revised for you. So that's all for today's lecture. I have revised all concepts of mutual funds. And the special questions, I've revised those as well. You shouldn't have any problem in this chapter now. Students watching on YouTube should not have any problem because I have solved the entire purpose for you with this video. So you all can revise comfortably now. If you have any doubt, put it in the comment section of this video. And do tell me how you liked the video, either in the comments or by messaging me, so that I also know whether you are understanding what I am teaching or not. And when you all give feedback, it gives me motivation too. And if you like the video and if you understand it, then what you can do is share it with your juniors or friends too. So that's all for today. Thank you so much. Radhe Radhe.